Okay, we are ready to get started. Welcome to you all. Welcome to the Joint City Council School Board Work Session of Monday, December 5th, 2016. We are delighted you all are here with us this evening. The actual joint work session portion, I guess, probably begins at 8 o'clock, but we are delighted to have our friends from the school board with us this evening, and our new, I guess, interim superintendent as well joining us for his first official meeting. So we'd like to welcome you, Mr. Schiller, to our meeting and to City Council. We're a pleasure to have you with us, and we look forward to working with you. So why don't we go ahead and get started. Mr. Shields, do you want to kick this off?
Thank you, Mayor Charter. Tonight is a night where we'll talk about finance, both long-term and looking ahead just directly to FY18. And we'll also look backwards. And so tonight we'll lead things off with our audit presentation. I'll ask our acting CFO, Melissa Ryman, if she could introduce our auditors. And what council has is I think we've passed out the actual comprehensive financial report document. And tonight is an opportunity to ask questions about it and discuss it. But let me turn it over to Ms. Ryman.
Thank you, Wyatt. Good evening, council and school board members. Tonight I present to you Billy Robinson, who is the partner on the engagement for the city's audit, and he is from the firm Brown Edwards and Company. They have been auditing us for over 6 years, I believe, and they're here to present the fiscal year 2016 audit tonight. Thank you.
Councilor.
Welcome.
Thank you. Councilors, school board members, thank you for the opportunity to be here. We sincerely appreciate the opportunity to serve the city and through our independent audit. We are a firm. We audit a number of local governments across the state of Virginia, so appreciate the opportunity to serve the city. I'm here. You guys have a very long session, it seems, tonight, so I'm going to go kind of quickly, just kind of hit some highlights, but I'm here to really answer any questions that you may have regarding the audit. The role of the independent auditor is to basically to verify the information in all material respects, that the financial statements are not misleading and accurate. And so just want to kind of give the background on what our role is. Again, going to hit some highlights, but please feel free to stop me anywhere if you want to stop and discuss anything specifically. You have in front of you the comprehensive annual financial report, which keeps getting thicker and thicker with different disclosures that are required by the Governmental Accounting Standards Board. You should have that in front of you. If you will pass over and just start kind of flipping through the first few pages. In the introductory section, what you're going to find, I'm going to point out a couple of things that I would suggest. If you go no further than this, at least read the transmittal letter and the management's discussion and analysis. This is done by city staff. We just read it to make sure that it is reasonable based on our audit of the financial statements. But that is really city management's description of the current initiatives and exciting things going on in the city, as well as some analysis regarding the fiscal year 2016 results. So just kind of want to point that out as included in the CAFR. If you flip over to the financial section, and the very first page of that financial section, page 1, you will find our independent auditor's report. In that, you will find that we issued an unmodified opinion, which is a term that is often used. It means that we believe that the financial statements are reasonably correct and accurate, and goes into further detail. It also talks about certain compliance requirements that we have to meet as part of that audit. Namely, the major compliance requirements are a single audit that with regard to federal funds, and we can talk about that just a little bit later. And then some requirements from the state for specifications for audits of cities, counties, and towns, and boards, authorities, and commissions, and both of those are referenced in that audit opinion. But just kind of want to give you a nature of what our responsibilities are. After that opinion, starting on page 4A, is the management's discussion and analysis that I highly recommend you read. Melissa and Wyatt do a really good job of explaining things for the readers of the financial statements, so I would suggest you have some time to please read that. Jumping straight into the financial statements, going to go over to page 5, Exhibit 1. The big thing I want to highlight here, the statement of net position, this is what is deemed basically the full accrual set of financial statements. The Governmental Accounting Standards Board has different ways of looking at things, so you have both fund basis financial statements and government-wide statements. The government-wide statements are intended, rather than focused more on a cash in, cash out method, which is what a lot of your fund basis financials are based on, particularly the governmental ones. This is really focused on a full accrual where all liabilities are recorded on the balance sheet, all assets are recorded on the balance sheet, including capital assets, et cetera. And so it's intended to be, if you were going to somewhat compare this to what a business enterprise would be, this would be the statement that you would look at. The primary thing I want to highlight here is a change that occurred last year, but still has a significant impact on the financial statements, and that is the last year, all of the pension liabilities, there was a move to a mark-to-market method for pension liabilities, and prior to that, basically pension liabilities were recorded as cash was spent out into the plan as long as you were funding the required contribution, whether both at the school board or at the city. Last year, any unfunded liabilities related to those plans came on to the locality's financial statements. And I'll point out a couple of numbers here for you. If you look at in the assets section, just up from the bottom of total assets, you'll find a net pension asset. The city's plan actually is not underfunded. It is indeed overfunded to the tune for the city is $8.3 million, and there's a school board component to that for some school board employees that are on the city's plan to the tune of about $1.4 million. A lot of that increased funding was due to the funding that the city chose, the additional contribution the city chose to make to those plans in fiscal year 2015 resulted in a net pension asset for those plans, which is a good thing, very good thing. For the school board, particularly for the state, the teacher plan, you'll find under the liability section, about 3 up from the bottom, the net pension liability. That number has grown from the prior year. That is about $40 million. And that is due to a number of factors. We've talked about it before. A lot of that is just due to the state's poor funding of that plan, particularly during recessionary times, because since the state contributes partially to VRS in times of economic shortfall, they have not fully funded that obligation. Unfortunately, that liability falls upon the school board's financial statements, but it was indeed a funding choice that was made statewide. And so if you compare your net pension liability to school systems across the state, you're going to find similar figures, because literally the way the liability is calculated is you take all the total liabilities for the pool, and then you aggregate and separate those liabilities out based on your proportion of payroll into the plan. So just kind of want to highlight those two factors there, and that results in a negative net position for the school board of a negative $30 million. Now, you'll find some localities in the state where most of our school boards right now are showing negative net positions. You'll find a few that do not. Some localities choose to issue debt through the locality and then transfer the funds completely to the school board. So the assets are all reported on the school board, but the debt is indeed reported on the locality's financial statements. That is not, and that was an accounting position that was chosen many years ago when GASB 34 was implemented, but the city did not choose that. The way the city transfers is as assets are paid off, then the net book value of the remaining assets are then transferred to the school board after they are no longer encumbered by outstanding debt. So if you compare yourself to other localities and you see a difference there, that could possibly be a reason. At the end of the day, the total reporting unit, including the city and school board, are the same. It's just some allocation of how those things are reported. If you move over to page 9, Exhibit 9, the only thing I want to highlight there was a rather substantial amount recognized this year from voluntary concessions in the Capital Projects Fund for some capital economic development projects with the city. So that was a rather large transaction that hit the financial statements, but did want to highlight that. If you move over to page 13, similar to that, the sewer fund down under non-operating revenues had availability fees paid to the tune of about $2 million. And it's my understanding that council designates a lot of those availability fees. So some of the cash you see there that is shown indeed is unrestricted. Actually, council has a policy regarding those availability fees, and they are designated as such. I think we talked about it to the tune of about $5 million for those. So just two kind of highlights of larger transactions reported in the financial statements this year. If you flip up with me over to page 35, you will find a new disclosure under the fair value disclosures. This is nothing major. There was a new disclosure requirement this year that actually made us report similar to what private companies and public companies have had to report for a long period of time, which is level 1, level 2, and level 3. And basically, what we're trying to, what the intent of this disclosure is trying to tell you how the market values are determined. Level 1 is very easily determined. They are easily determined with market prices. They trade frequently, et cetera, and there's explanations in there. Level 2 is, it's a little harder to place a value on, but it's not exactly traded on the open market, but there is a way of establishing a value. And your level 3, which is more the property fund, and this is primarily in your pension. These investments are primarily in your pension plans. But again, nothing unusual here, nothing different from prior years, other than the disclosure is a little different and a little more detailed. If you go over with me, and we're going to pass through a pile of pension disclosures, go over with me to page 86. You will find some new accounting standards that will be applicable in future years. The big things that are going to affect the city's financial statements are for other post-employment benefits. So this is for benefits provided to retirees other than pensions. Primarily, this is health care, the ability for a retiree to stay on the city or school's health care plan. Much like in the past, this standard was bringing the liability in over time with an intent to adjust the liability as it went up. It is actually going to follow the pension standard almost exactly, and so it will be a mark-to-market, and all those liabilities will then come on the balance sheet in 2017. So I'll show you kind of what that looks like here in just a moment. The other disclosure to highlight is the tax abatement disclosures. There's going to be a new disclosure requirement. Any individual tax abatement relationships that a locality has, if it's considered significant, which a lot of them are, would require that you actually disclose the nature and magnitude of those tax abatements inside the financial statement. So that it's not tax abatements to the whole. So if you have like elderly tax relief, that's not a disclosure item. But any type of tax abatement deals with individual businesses will be disclosed moving forward. So just something to highlight there. And then actually you'll find a bunch of things about the pension in here because of all the standards they did a few years ago. They now want to change a couple of them because they found some issues. So a couple of those are just addressing some issues in the original standards. So nothing of major significance there. But OPEB and the tax abatement could have some impact on the city. If you move with me to determine the potential liability to page 89, Exhibit 13, it's a few pages over. So this is the schedules of funding progress for the other post-employment benefits. So one thing that the city and school system has been doing for a number of years is trying to fund the other post-employment liabilities as you go, what you consider the ARC. And actually, you guys actually have some overfunding in that to the tune of an asset. To the asset that is recorded on the OPEB plan currently is $3.7 million for the city and $1.3 million for the school board. Well, when you actually record and all of that liability at one time, you're actually going to have an unfunded position. There will be some differences in the calculation, but if we were assuming that the calculations from the old standard were applicable and you would put those balances on the balance sheet, as of June 30th, 2014, the city had an unfunded actuarial accrued liability of $6.7 million, and the school board has an unfunded liability of $2.4 million. So when that standard is implemented, I would suspect that a number similar to that will be recorded as a liability on that Exhibit 1 full accrual financial statement. So just something to be aware of. On the next page over, pages 90, 91, and 92, Exhibits 14, 15, and 16. I won't talk about any of these really, but I would think it would be interesting to note eventually there will be 10 years of information reported here. There's now 3 years of information reported here. And this really is all of the changes in your pension liability and the nature of those liabilities, the changes in your pension assets. So it kind of gives you a feel based on, and as you can see, like for example in Exhibit 14, under the plan fiduciary net position contributions employer, there was a large spike in 2015, and that was from your funding, that choice that you made with the funds from the sale of the water system you chose to put towards the pension plan. So again, it's just information that you may find relevant as looking over time, and those were exhibits that were in the financials last year, but something that now that we add years to it may become more informational. If you flip over with me to page 97, there is one violation of the budget provisions that's reported in the statement, the schedule of findings and question costs. This is a violation we've had in, I think last year. And this has to do, basically the Appropriations Act says that you have to adopt the budget based on a legal level of control. For you, it is departmental budget, and then anything that does not fall within a department is considered non-departmental. You had one department, Development of Services, that exceeded that budget, and per the requirements of the specifications that we have to follow, we have to report that as a budget violation. And so our recommendation would be try to make some attempts to amend budget as necessary and make sure you're not exceeding the Appropriations Act. Not a huge deal. A finding we often see, because it's a little hard with the timing of year-end adjustments to make sure you get all those captured, but something to be mindful of. And then with that on page, if you flip with me to page 141, which is almost all the way near the back, this is our schedule of findings and question cost and lays that out. We still have a significant deficiency regarding segregation of duties that is outlined there. Primarily, it has to do with cash receipts and write-off of receivables at the city due to not enough manpower to properly segregate duties, specifically within the treasurer's office. And then the school board still has some segregation of duties issues with accounts payable, payroll, and journal entries, and also seems to be a staffing situation as well. But something we are required to report as a significant deficiency as we believe it rises to that level. There's some other things that are noted in here, a couple of findings related to the testing we have to do for the state, a couple things on highway maintenance that are outlined there, but have been there. We've had issues there before, but the city seems to be addressing those issues and improving the record keeping of that. It's not a significant issue. The state is pretty particular about what they call a violation of that, and they're not real good at giving guidance to people. So, but it is something to note and something that we are required to report on. The only other issue I would point out is this year, I spoke of federal funds earlier. If you look on page 143, between the city and school board, there was $1.4 million of expenditures of federal awards. We were required, based on the testing criteria, to test 2 of those programs, and so we ended up testing the special education cluster to the tune of about $406,000. So that was the single audit grant program that we tested. We don't test all grants. We go through the requirements of selecting a program, and more often than not for you guys, unless you have some very large transportation grants, more often than not, special education is going to be the grant program that's tested because it is the largest. For a lot of localities, the lunch and breakfast program is significant, but due to the demographics here in the city, that's not a significant funding source for the school board, so we don't test that here, but do hit the special education cluster. So I went through that kind of quick and trying to recognize the schedule that you all have, but I'm happy to answer any questions you may have.
Sure, Mr. Akuma.
Thank you, sir. So back to our 40 million, I'm on the school board, so.
Sure.
It's the 40 million. Is that a recognition of everything brought to date? What I mean is, are these liabilities things we have to pay over time?
That's
or
correct.
you just aggregated them for purposes of this balance sheet?
Yeah, a $40 million check is not necessary in the next 2 years.
Because that's all we have for the whole year.
Right.
So.
No, it is a recognition of funding over time, and the state has, and Hunter can probably speak to this better than I, but the state has actually implemented plans to decrease that liability. So there is a funding mechanism in place where there are increasing contributions, and maybe Melissa, you could speak to that better than I could.
Hunter could probably speak to it better. But there is in the General Assembly budget adopted last year, they had intended to accelerate funding of the liability beginning in fiscal year 2018. Although there is now talk that might be deferred further.
You have some commentary, sir?
Of course, Melissa put it very accurately, clearly, and succinctly. Essentially, when the VRS board recognized the underfunding back in the 2011-2012 period, they put forth a schedule of biennial rates, I believe through 2019 or 2020. And again, they're biennial rates that the rate would stay the same for 12, 13, 14, 15, and like for what we're looking at right now is FY16 and FY17. Last year during the budget, the governor proposed and the General Assembly went along with it, accelerating the fully funding of the VRS. So whereas we would normally see the same rate next year, VRS rate next year that we have this year, right now what's officially out there is about 11.5% higher than, it's about 2 percentage points higher than what the VRS board had originally put into place in 2012. That is, the General Assembly and the executive branch are being lobbied quite hard right now to return back to the original schedule.
Thank you, Hunter.
Other questions, comments? Mr. Duncan?
Thank you for your presentation. Would you care to venture advice to us on the segregation of duties deficiency, given the size of our enterprise and the amount of money that we're handling? As I understand it, we basically could either hire more people to cure the segregation of duties problem, or another alternative would be to hire an internal auditor to watch over the people who are insufficiently segregated.
Sure. I mean, how you address the problem is a matter for governance and for both the school board and the city to address. It is a significant issue. It's why we determine it and call it a significant deficiency. It is, there are certain comments that we report in a management letter that are just some comments and suggestions that don't rise to as significant in nature. The fact that this is reported in the comprehensive annual financial report means that we deem it sufficient enough to specifically point it out to governance and specifically point it out as an area that needs to be addressed. How you go about addressing it, I mean, is a matter of choice and analysis that I as an auditor cannot undertake. What I can tell you is that addressing the issue, people are concerned either way. You either have to have the people with the ability to segregate the duties, and have enough people with the ability to segregate duties, or and the real answer is that, so the question on the internal audit, whether or not that's something that's a good investment for the city, is in my opinion a decision for this council and the school board. But it doesn't necessarily, hiring that position does not necessarily make that weakness go away. The weakness still exists if duties are not segregated. Now, does it mitigate some of that weakness and some of that risk? Possibly. Would it mitigate it to the point that is no longer a significant deficiency? I couldn't say that, but it doesn't it doesn't address the underlying problem of the deficiency itself.
Thank you. Just one other question. In the letter of transmittal, which I know has the manager and the CFO's name on it, but the letter of transmittal, goes through the numbers on, I think, page Roman numeral 5 of new investment in the city over the last 10 or 12 years.
Sure.
It's a little over half a billion, that's with a B, dollars, which generates enough net tax revenue to be the equivalent of about 7 or 8 cents on our tax rate. Can you, based on your work in other jurisdictions, just sort of compare what Falls Church has been able to accomplish in that area to what other jurisdictions that you work with have done in that same time?
Economic growth. I think if you just look at, I'm an auditor, so I'm not a financial advisor. I'm not your financial advisor. We're just here to verify the numbers, but I don't think it would be a stretch to say that economic growth in the Northern Virginia market has been better than the state average at times, but it also has shrunk better than the state average at times. What the city is able to accomplish, obviously there's a fair amount going on. There's plenty of new buildings as we drive down the street, so I would like to call those accomplishments.
Okay, thank you.
Mm-hmm.
Mr. Z?
Thank you, Mayor. I recall several years ago that we were caught in the headlights with GASB 65 and 68. Forgive me if I don't recall those numbers, but two of those in the 60 series that compelled us to think very long and hard about how we treat our pension liability, and as a result, we put a lot of money in there.
Sure.
And so I assume you know these numbers better than I do, and tonight you present us with an additional set of numbers from 74 to 84, and you say that these may have some implications that would affect our financial reporting and other kinds of things. So can you or anyone on the CFO staff illuminate us on what some of the top things we need to pay attention to going forward with regard to these GASB's requirements?
Just hope they quit making them.
What's Plan B?
Ultimately, the Governmental Accounting Standards Board, it has said that its stated objective is to provide more transparency inside the financial statements. So much like the pension liability of $40 million, or the asset that the city now has for its funding with the water sale proceeds, that liability is always, it's existed for some time period. It wasn't created overnight. It just wasn't really reported in the financial statements. The teacher pension liability has never, until this standard, the underfunding amount was never reported in any locality's financial statements. So the Governmental Accounting Standards Board is really trying to bring these types of unfunded liabilities onto the balance sheet. Now, as I sit here today and what I know of I don't want to predict what they will do. I can't think of any potential unfunded liabilities that are sitting out there after OPEB that are sitting on the financial statements, but I don't know that that necessarily answers your question. So I'll let you, if there's anything else to add to that.
No, I think that does. Thank you very much.
Any other questions or comments? If not, we will thank you for your fine work this year and look forward to seeing you again next year.
Thank you
Thanks
so
so
much
much
for
for
your
coming
time.
out.
Thank you.
Thank you and welcome as well to our table here. So look forward to seeing more of you as well, Melissa. Thank you.
And Melissa actually is going to stay with us through the
Oh,
through,
okay. Well.
through all of tonight's proceedings. In fact,
Okay.
has a star role in them. So
Well, good. Thank you.
I will just point out that the comprehensive annual financial reports will be available on the city's website tomorrow. I will be setting it up for upload. Thank you.
Thank you.
now I think it's available. It was available on Granicus over the weekend. I
Right,
guess.
correct.
Yeah.
Okay, well, thank you. So why don't we move on to the next portion of our meeting, which is the formal joint meeting with the school board. I know we've got a few folks we're going to welcome, at least one. Thank you for coming back. Appreciate all your good work. Mr. Shields, is there anything to do to set this up?
Yeah, so Tim is here, and he is going to give you all updates for your campus roadmap project notebooks. And as those documents are being passed out, I think everybody gets a folder.
Do it that way.
Do I get one, or?
Yeah, you. Oh, let's have one too. Then I have a couple of extra if we need them.
Okay.
The one.
So we've had a working group meeting in which we worked through the material in preparation for tonight's meeting. And I'm going to turn it over to Tim in just a moment. I think he'll get us oriented on what we're trying to accomplish tonight. The focus tonight, though, is on the question of the spectrum of affordability. So it's question 12 on the council's list, the council and school board's list of key questions. And so that will be kind of, I think, where we'll spend most of our time tonight, and we'll try to check off a few extras as well. And let me turn it over to Tim, and he'll lay it out for us.
Perfect. Thank you, Wyatt. Really excited to be back here. I think, as you all saw in the last joint session, the working group has been making a lot of progress, being very diligent, working through these questions, making sure that we have the right information, making sure we're discussing the key points of it, and then bringing it back to this group to share. So we wanted to make sure that December continues to be productive, and even though this meeting was only a few days after our last working group meeting, we wanted to make sure we had a chance to get this information in front of you, because the financial modeling and the financial numbers are so crucial and so at times complex. So Wyatt and his team with the city put together the financial modeling to take a look at the debt service for the city and to look at the question of affordability, which he'll break down as what can we factually, legally afford, what can we borrow under our current policies, and then with some creative modeling, what could we get to and what numbers could we achieve if we have a little bit of flexibility in some of those policies. So the updated materials you have before you are focused on question 12. You'll see an updated questions list that's just to make sure everyone has the most current list of questions for the full spectrum. You'll see a sheet similar to what you had for the school board ones. It's question 12, and it breaks down all of the subsets of the question, as well as a very brief bullet of answers. This is your quick and dirty version to say what we can afford currently and what we might be able to do to borrow a little more, as well as a list of the additional items. If you turn that page, what you have before you is a little bit more detailed breakdown of each part of question 12 and everything it gets into. A reminder, that's 12A, how much can we afford right now with our current policies? 12B, if we break policy, what can we afford? What are the repercussions of breaking policy? 12C, how much could we afford if we change policy? 12D, are there TIFs, special tax districts, or additional creative funding methods available? 12E, is $120 million possible? What are the bonding and development implications to ensure a stable future for Falls Church? 12F, what are the tax implications of each tier across the spectrum? And 12G, what are the debt timelines associated with each funding option? Because most of these questions are interrelated, you'll see them played out over some different charts and graphs that Wyatt will walk through in his presentation. And if you flip past this breakdown of details, you have a copy of that presentation as well, so you can follow along with a handout. After the presentation, which is 21 slides, there are a couple of tables that have the raw numbers of what this would look like in a debt service table. Wyatt will have some updated versions of those that are color-coded to guide you through the numbers. And then following that, there is the explanation of tax increment financing and community development authorities, and then a risk analysis memorandum from Davenport and Company. So it's a comprehensive packet. What I'll be doing as we go along is marking down anything Wyatt says that may need further attention for the working group. And as we have questions and discussion afterwards, we'll make sure that we take any additional questions or considerations that you all have back to the working group to either get more details or to clarify anything as needed. So with that, Wyatt, I'll turn it over to you.
Okay. Thank you, Tim. So we'll focus on this question of affordability, and I'll just say at the outset, it's been a very busy couple of weeks for our Melissa and the finance team, because they really worked hard to pull this information together for you. I drew the straw to present this information. Melissa will present the FY18 budget projections, which will be after we're finished with the campus planning. So in terms of affordability, we've broken it into sort of two big groups of how we assess the affordability of the city's capital program. And on the factual basis, we can look at industry metrics, and then arguably on the opinion side of it is really a political question of what is reasonable for the taxpayers of Falls Church to shoulder. When you're talking about debt, if you're willing to raise the tax rates to pay all the debt service, then a lot of these industry metrics, which are metrics of risk, go away. But there's a lot of political risk when and other sort of permutations of risk in asking the taxpayers to pick up such a big burden. So we try to measure that burden in the following four ways in this presentation. Debt to assess value is a very traditional way to evaluate risk. Assessed value of real estate is the basis of most of the revenue for the city, 60% of our revenue. There's a state law cap that you cannot have debt that exceeds 10% of the assessed value of your jurisdiction. We currently have an assessed value of just under $4 billion, and so that would be a cap of $400 million of debt. That's a very big cap. The city's policy is 5%, half what the state law cap is, or $200 million of debt. We'll run right up to that policy cap with the if the full CIP is adopted, we're put into place. Debt service to total expenses. This is a metric that we look at with every year's CIP. Currently, 8% of our budget goes to debt service. Our policy cap is 12%. There is no state law on this limitation. Payout ratio. What this stands for is how much of your debt is retired after 5 years, how much of your debt is retired after 10 years. Our policy today is that 1/4 of your debt should be off your books. It should be retired after 5 years, and half of it should be retired after 10 years. What that basically stands for is we typically structure our debt as 20-year term debt. That comes into play because we've discussed potentially doing the high school with 30-year debt. And then lastly, debt per capita is something that bond rating agencies and investors look at. We'll show some regional comparisons, but there's no law or policy cap that speaks to this. And then we'll run some scenarios in terms of using our debt service model, how many pennies on the tax rate, or what's the impact on the average homeowner's tax bill. So let's start the discussion just by looking at what we have on the books today. We have $51.6 million of debt. About 75% of that is for school facilities. About 25% of that today is for general government facilities. And this is the debt service for that $51 million of debt that we currently have outstanding. It's just over $6 million in the current fiscal year. The purple line in this chart is the 12% of expenditures policy limit. And that's the first policy limit that we bump up against when we consider our capital improvements program. So on the question, the sub-question of question 12, I'm sorry, I'm not there yet. So we've modeled two scenarios. One is a policy constrained scenario, which is what's the maximum amount of debt that we could issue under existing city policies. And the one that we bump up against first is 12% of expenditures. The answer to that question is $70 million. That's how much additional debt capacity we have under that policy. If we took the adopted CIP, we have $30 million of projects that are for the library, for the City Hall project, for the purchase of land for schools, for other miscellaneous issues and projects in the CIP. That would leave $40 million. If that was left unchanged, that would leave $40 million for the high school project. Okay, 70 in total, 40 million for the high school project if nothing else was changed. The other that we model is the adopted CIP, and that is $145 million of total debt issued over the 5-year period. 114 million is modeled for the high school project and 31 million for the remainder of the CIP for the items I just listed. So just so everybody understands the assumptions that we're using in all of these scenarios, so on the two that we're running, we have the 12% policy limit scenario and the adopted CIP scenario. So under the 12% policy limit, that's $70 million of debt that we'd issue. We'd have a 4% interest rate. Assessed value of the city's real estate will grow at 2.5% per year. Our operating budgets will grow at 2.5% per year. The main issue there is that our operating budgets are going to be covered by economic growth. That's the main issue of that assumption, that there's no pennies in the tax rate for our operating budgets. It's only for the capital program. Other funding sources to help cover debt service costs in the 12% policy limit, there are none. We just play it the way we would traditionally finance our CIP and have done for years. And then we have an assumption for future borrowing after the 5-year planning period that $5 million would be issued every other year beginning in FY22. And so you'll see those numbers when we look at the graphs. So in the adopted CIP scenario that we run, the full $145 million is issued. We also have a 4% interest rate. AV and operating budgets are the same. The debt structure is stretched out, so it's not a 20-year term, but it's a 30-year term. And instead of using level principal payments, we use level debt service payments for the $114 million for the high school. The rest of the CIP, the other $31 million, is financed the way we traditionally do, with 20-year debt. Now, the key thing that we do for the adopted CIP scenario is we use the capital reserves of $9 million. That's where the level is today. We use that to buy down the debt service and shave the peak. And we also plug in land proceeds, which we've just modeled as $30 million. Now, we've discussed it being $40 million. We have discounted that because that one issue about infrastructure cost is one that we want to work out as we go through our planning process. So we've been conservative, and we've modeled that as a $30 million land proceeds scenario. We also model it as coming in 3 installments beginning in FY22. So we issue the debt first, and then these payments come in. We do not model future taxes from future development. We can handle that in the planning process, but just for this initial run, we don't model that. Okay, so those are the assumptions. Things that we don't include, again, new taxes from development on the campus. We don't model operating budgets increasing as a result of the new building. That's a pretty important issue that's, I think, on the council's list, and we have not yet addressed that. to try to model what the operating budget costs would be if you have a bigger facility. And if there's a new major capital improvements program, like an $18 million elementary school expansion or things like that that have been discussed, that is not in this model yet. That's not in the adopted CIP, and that information, I think, is evolving. So that's out for now. Okay? So if we chart out our, yes.
Can we just pause for a minute? I just want to make sure that I'm understanding everything and everyone else in the room is too. So to go back to the original questions sheet, specifically 12A, the very simple question of how much can we afford right now with our current policies?
Yes.
The answer is 40 million. If we change no policies to stay within our 12% debt limit, it's $40 million. Is that the
It's-
simple version?
It's 70 million in new capacity, so if you don't change any other aspect of the CIP except for the high school project, you have 40 million for a high school.
Okay. And if we don't deprioritize anything else in the CIP,
That's correct.
then it's 40 left.
That's correct. All right, so this is the debt service chart of the blue bars down here you saw in that initial chart. That's your existing debt service. We have a major step down in FY '22, and Mary Ellen Henderson comes off the books in FY 2025. So the for 70 million of additional debt, that would increase our annual debt service up to about $12 million a year, or roughly a doubling of our existing annual debt service. As we note here, that if you don't change the CIP, that would be 30 million for the CIP and 40 million for the school project. And then this light blue in the out years is the new debt service for issuing $5 million of debt every other year. So that's what we're calling the policy, 12% policy constrained scenario. And then the full adopted CIP has all the existing debt service. It has the City Hall project. It has miscellaneous school projects like the purchase of additional land. And then we have the library here. It's the green bars. That's the debt service for that. And then the red is the debt service for the George Mason High School project. And the light blue is the same as modeled in the last one. So in our peak years, we exceed the 12% of expenditures policy limit by about $3 million per year. So let's look at some of the metrics that the industry would use to evaluate the risk of this amount of debt. We're going to compare ourselves against a basket of localities in Northern Virginia, starting with Purcellville, Manassas Park, Vienna, Herndon, City of Fairfax, Winchester, Fredericksburg, Manassas, Leesburg, Alexandria, Arlington, Loudoun, Prince William, and Fairfax. So in terms of total debt outstanding, obviously the larger jurisdictions have more debt. A more useful comparison is how much debt do they have on a per capita basis. So on average, there's just over $3,000 per capita debt in the Northern Virginia region. Currently, the city is just slightly above the average of this basket of localities that we're comparing ourselves against. With the full CIP, we would be almost 3 times the average, almost $12,000 of debt per capita. And if we went all the way up to our policy limits, we would be just over $6,000 of debt on a per capita basis. Now, Purcellville and Manassas Park do have higher ratios than that currently, but that would be significantly higher than average. So that is that's one metric, and it fairly well captures the scale of the capital improvements that we're contemplating. Yes.
Another assumption that we talked about in the working group that's not in there is that the population will keep growing,
That is correct.
right?
So we're assuming that our population is going to grow roughly aligned with the other jurisdictions in this area. So these metrics wouldn't change significantly on the population side. They would change much more quickly on the debt side. Fairfax City is one that we look at as a pretty good comparison for us. They have a high debt per capita, and they had a very ambitious capital program where they built a new police station, a new high school, a new library, and they renovated and expanded their city hall, all in a very short period of time. And we've toured many of those facilities, but that was their big capital lift, and they did that in the 2008 to 2010 timeframe. All right, debt to assessed value. Thank you. Debt to assessed value. So here is the city's policy limit at this red bar at 5% of assessed value. So if we adopt the full CIP, we would be just below that policy constraint. The average for the region is about just under 2.5% of assessed value, and currently we're below average and at just over 1% of our debt is 1% of our total assessed value. Yes. Mm-hmm.
This is based on what the worst case scenario is for us, vice the current indicators for each of the other jurisdictions, right? I'm curious what the city of Fairfax was
When
it
issued their
first
debt?
completed, as opposed to now. I assume that its debt per capita was higher than it is now.
That is correct. They have paid off now 5 years of their debt. And for instance, and with this metric, their assessed value has grown since they issued their debt. So this would have been a more stark picture for the city of Fairfax at the time that they were doing their heavy lift. I don't have that chart. We could go back in time to look at it, but Davenport, who is our financial advisor, was Fairfax Cities at the time, so they're very conversant with when they were grappling with their challenges and how they looked at it. Okay, debt service versus expenditures. The 12% limit is shown here as the red bar here on the x-axis. So the average for Northern Virginia is just over 8% of budgets goes to debt service. We're below that average today, and at our policy constraint, we would come. This is the marker that limits how much debt, so we go right up to it, and then the full CIP would get us up to about 15% of our budget would go to debt service, and that would be higher than any jurisdiction in Northern Virginia. Now, the 10-year payout ratio, this really is a measure of, for your successors, what position will they be in 10 years? They will have capital challenges, they'll have budgetary challenges, and so how much of their debt will be paid off, of the debt that we would be issuing for this project will be paid off in 10 years. So in this one, a high number is good, and a low number is a sign of a lack of flexibility or lack of room to maneuver in the out years. So on average, the Northern Virginia jurisdictions would have, in 10 years out, 70% of their debt will be paid off. We're above average currently. We'll have just under 80% of our debt will be paid off in 10 years. The policy constraint would be right at 50%. And the full CIP, only about 1/3 of our debt would be paid off at year 10. And so that's another one of our policies that we're bumping up against with the full CIP. All right, let's look at the question of affordability from a real estate tax rate perspective. Currently, our tax rate is, and we'll cover this with some other charts when we get into the FY18 budget presentation, but we're lower than some of the smaller jurisdictions, and we're higher than all of the larger jurisdictions in terms of our current real estate tax rate. With the policy constrained limit, what this stands for, remember, is if we take a very traditional approach to financing all of our capital needs, and so that actually results, even though it's a smaller amount of debt that's being issued, and a higher tax rate required to service that debt than the full CIP, because we model some things like using land sale proceeds and capital reserves to pay down the debt service in the peak years. So the way we've modeled this, the full CIP actually has a lower tax rate. It's certainly subject to a lot of discussion. It's a key thing that everybody understand exactly how that works. And so for more detail on that, we do have a detailed chart of how the tax of how the tax rates would work, and that is in your handouts. Did we ever get a copy version, a color version? Okay. Let me pass out this one. It didn't print in color, but it has a slightly larger font size, so it's a little bit easier to read. While it's being passed out, I'll put it up on the board as well.
This is a larger font size?
That's all right. When we were with the working group, there's a recognition that we need to present this better, but I have a hard time breaking out. I feel like it's very important for the council and the school board to understand in a granular way how this all works before sort of making big statements about it sort of in the simplicity of a PowerPoint presentation. All right. Share drive. So in this scenario, that this is basically a model run with a summary sheet that is kicked out by the model. So if we issue 30-year debt for, and I'll start up at the upper left-hand corner and just walk us through this chart. If we issue 30-year debt for the high school and for Mary Ellen Henderson, and 20-year debt for the rest of the CIP, and we use the capital reserves to pay annual debt service, particularly in the peak years, and we include the proceeds from the sale of land, that's what this model run will show. So it assumes that next year that we go to referendum and the voters approve the project at the full CIP amount. In order to get through the initial planning and architectural and engineering, we would issue debt in FY18 in the amount of $10.2 million. And then in 2019, we'd be getting into construction, so we would issue $56 million in 2019, and then $47 or $48 million in the year 2020. Again, it would all be issued at 4% interest rates. That's their assumption. And then the rest of the CIP would be issued per the schedule of the CIP. So then if you look at the main chart and follow the fiscal years down from 2018 all the way out through 2040, our total debt service peaks out at $15.3 million, and that's the first shaded box. So that's 6.7 million higher, $7.9 million higher than our current debt service. So in order to pay for that, in FY19 at a minimum, there would need to be 8 pennies on the tax rate. And what that would generate is just over $3.2 million. And you would contribute in FY19, a sizable amount of that would be contributed to the capital reserve balance. So your capital reserve balance would go up to $10.7 million. Then in subsequent years, you would use those capital reserves, you would draw down from the capital reserves to smooth out your debt service payments. So it would go down to $9 million, and then so it's $3.7 million. And the next shaded box, however, we have the first of the $10 million payments for the sale of land coming into the capital reserve, so that bumps that figure up to $8.7 million. That's the red shaded square on the television. Then we continue to draw the reserves down at a pretty significant clip of over $4 million per year. And then the second payment for the sale of land comes in FY 2024, and then the third payment comes in FY 2026. And we'll refine these modelings as we go through our planning process for the site. This is a fairly simple 3-phased commercial development program up on the campus, and so the land proceeds are tied to that basic notion. And so then if you look at the metrics that are laid out in the columns to the right, our payout schedule, we would have paid off 19% of our debt at year 2023 and 35% of our debt at year 2028. Those ratios should be 25% and 50% respectively per policy. The impact on the median homeowner's tax bill at 8 cents on the tax rate would be $544. Now, this is not cumulative, this is each year. And so don't add those numbers together. We're not talking about 8 pennies and then another 8 pennies. We're talking about 8 cents. That gets you through the first 2 years. And then per this model, if there are no other needs for tax rates and all these assumptions play out, then you're able to reduce the tax rate because those capital reserves kick in and start to pay off the peak of the debt service. A couple of the other columns, and I'll stop on this. I know this is a busy chart. It's got a lot of things going on in it, but it's important to understand how these things work. So our debt per capita, which we've talked about, that goes up to that $11,967 dollar amount in year 2020. That's the figure that's roughly double anyone else in the region. And then our operating and total budget would go up to $100 million, and we would exceed debt service would exceed our policy target and go up to 15% in those years between 2021 2022, and then it would start to come down basically as the natural growth of our budgets begin to catch up with it. So that's just one. This is sort of the full CIP model run. The key thing to understand about it is the importance of those capital reserves, and that's the essential element of how that option becomes remotely affordable. From the other metrics, though, it's clearly it's a significant amount of debt on the city's books. Yes.
Can we pause here, because I agree with you that while this is a lot of numbers, I think it's important for us to understand kind of how this aggressive financing scenario works. And so I'm going to attempt to do what I did in the working group, which is try to summarize it in my version to make sure I'm understanding it, and maybe it'll help other people understand. So in this kind of very aggressive financing scenario, there's a bunch of assumptions and levers that we're pulling to kind of make this all work. Right. The first one is using 30-year debt versus traditionally 20-year debt that we use. Mm-hmm. The second is using capital reserves to pay annual debt service. So in my mind, I liken that to using your savings account to pay your mortgage bill, right? Yes. Versus using your monthly cash flow, your income. So that's kind of a big nuance, I think, to understand. The third is assuming that we sell the land. So that's another big assumption, because I know out there in the community we've heard discussion of do we sell it, do we not sell it? Using this aggressive scenario where we're trying to finance $114 million, this requires us to sell the land and assumes that we get $30 million from it, which might be a little conservative, but probably better to be err on the side of conservative there. The fourth lever I jotted down is we assume AV growth, assessed value growth at 2.5%, which seems pretty reasonable given where we are historically. The fifth one I wrote down is this assumes that the land sale actually happens, and it's kind of every 2 years, so there's kind of a big risk there that actually happens in that scenario and that timing, because that's when we need it to shave off the debt service peaks. The next one, which I think is really relevant for the next part of the discussion, is also assumes operational budgets are funded with no tax rate increase each year, that essentially it's funded with whatever economic revenue growth happens in the city. So all these pennies assumes nothing's happening on the operational side. We're able to keep it at 2.5% to match AV growth. The next one is assuming that this is the adopted FY17 CIP, so it doesn't include the new potential elementary school costs that we just talked about. So with us hitting Mount Daniel capacity in 2019, I think before Dr. Jones left, there was potentially a placeholder put in there for $18 million to another school. So that doesn't include that, because that then would be $170 million CIP.
Right.
Did I get everything? Was that kind of the big, and it's a lot, but are those the big kind of levers and assumptions? And I think it's important for the group to understand the summary of that too, because there are a bunch of risks, I think, inherent in each of those assumptions. So with that said, you mentioned Fairfax was kind of a good example, given that they had done a bunch of capital improvements. Did they use a lot of these similar levers to make this happen?
They did. They did not. They did not have a significant economic development program that was helping pay for it. They did not use capital reserves in the same way, and I think we can still learn a little bit more how they absorbed that. But essentially, they handled it through their tax rate and through their operating budgets.
One more thing. And the other thing that we haven't talked about, but I feel like is kind of a big risk for us regionally, is WMATA costs. So while we may be able to control in this room how operational costs will go, I'm personally very worried what WMATA costs will look like in the next 10 years, what we all maybe need to shoulder capital-wise. We already had to deal with it last year with the operational budget. So I feel like that could be a big wild card that we're not factoring, is how much we may all need to shoulder the cost for Metro's infrastructure needs.
We don't know where it's ultimately going to go. We do have a clear picture at this point that WMATA is going to ask us for $500,000 in FY18, above what we're currently paying. We'll talk about that in the FY18 budget.
They were asked for 400 more last year, right?
Yes.
So it's 900 total from above 500 about that. Okay.
Yeah.
Thank you.
So when we were revising the fiscal policies, you mentioned that our financial advisor had suggested that if we were to break the 12% cap, we would need additional unassigned fund balance. Did you include the pennies to fund that unassigned fund balance in this scenario?
I did not. And when we get to the FY18 budget, however, we will have a slide on discussing capital reserves and unassigned fund balance, and with a recommendation in FY18 that at any rate, looking at what we're looking at and trying to put ourselves in a position to accomplish these things, that FY18 would be an appropriate year to begin having funds dedicated for this project. Initially, they would be to be placed into unassigned fund balance or capital reserves, essentially to strengthen our position for the project.
But would you say that it would be fair to say that if we looked at the real estate tax rate chart, that if we included the impact of the unassigned fund balance funding requirements, that the full CIP would not be a lower real estate tax rate than the policy limit?
I think if it were begun in 2019, then yes, I think it probably would be. It would have to be additional pennies above what's modeled here. If it's begun in FY18, it might not need to be additional pennies. You might be able to just get there by starting a year early.
I really like how Ms. Hardy talks about these different levers,
Yes.
because I think that makes us think about how we can stretch this differently and just make it work in different ways. The one thing I'm concerned about is when we're talking about these real estate pennies and operating budget. This is just a CIP chart, right?
Yes.
There's no operating budget in there at all.
Correct.
So we sort of need to have a little big asterisk here that says that. This is just CIP, no operating. Because I fear that if we start talking about that, we can't even imagine what operating in 2033 is going to look like.
I guess I would say the operating budgets are in here, but there's an assumption that there's no pennies in the tax rate for operating budgets. That's the salient assumption of the chart. And there is a column for operating, and it grows at 2.5%. But really the most important thing, I think, is that there's no pennies modeled for operating budgets.
So what question? So this, just to be clear, where you've got real estate pennies required, the 8 and the 8 and the 6, and as you go down the chart, that's annually.
So in 2019, you would need 8 cents on the tax rate higher than it is today.
Okay.
In 2020, you would need 8 cents higher than it is today. So it's not 8 plus 8. It is simply
okay.
you're at the level of 8.
At the 8. Okay. Okay. Thank you.
So, Ms. Shields, you're assuming $30 million from economic development, is that right?
For the land sale, yeah.
Okay. How did you come up with that number?
That is a number that is based on the city's consultant, Saville Studley. When they valued the property, they made some assumptions about the amount of density and amount of development and the types of uses, and then they valued the land on that basis. They came with a valuation, if you assume, I think they modeled 1.1 million square feet of development on the 10 to 8 acres of the campus, that the value of the land then would be 40 million. So we have discounted that slightly just for modeling purposes here. That's the source of that number.
Okay, and on the tax impact on median homeowner bill, does that include the 2.5%
Yes.
increase? Okay, all right.
So AV goes up, and then we have the pennies go up as well. The AV assumption being the 2.5%.
Okay, thanks.
Okay, we've got some other questions, sorry.
We do have a few more slides if anyone's
Can I just ask a bunch of questions?
interested.
One, just to follow up on what Ms. Conley and Ms. Hardy said, I am definitely concerned about the 2.5% operating growth rate. I think that's probably going to be unrealistic, that we won't add any pennies to the dollar if we want to keep our schools in the competitive and excellent nature they are right now. But I also want to ask how changing our policies would impact our bond rating.
Yeah. Well, I think that's a good segue into the risks. And in terms of our bond rating, so here are the things that we've identified as the key risks to what we're modeling here. And Davenport has weighed in on this. In your packets is a memo from them. It's still in draft form, but I think it lays out essentially what the final determinations would be. The model does have the risk that AV growth is not going to be 2.5% per year. It's going to go up, it's going to go down, it's going to be a much bumpier ride than that. And interest rate risk, we've modeled 4%. If interest rates right now are on an uptick, particularly the longer term issuances, it's a period of a great deal of change in the bond markets right now. And so currently those long-term issuances are still below 4%, but that's a risk. The property proceeds, how that all works out, that's a risk to the model. And so a credit downgrade for a jurisdiction, because of all those metrics that we've walked through, where the city currently is in very solid condition on any of those metrics that you look at. Hence, we have a AAA rating from Fitch and from Standard & Poor's. That we do have the risk of a credit downgrade. Our credit often our rating is per issue, and so for a big issue, that big issue could get a lower rating. The cost control risk in terms of we're modeling a $112 million high school with $2 million of financing fees for a total of $114 million. As you go into a complex project like this, there's some risk that those costs could go up higher than what we've modeled. Political risk that Davenport identifies is essentially, I think from an independent observer, that you could have an elected body that is committed to a certain plan of finance, and then you could have a new political body that has a different idea of the plan of finance. And so a bondholder has to think about that. And then the other issue of other capital needs that might be out there that we have not yet put into the CIP. Those are some of the risks that Davenport has identified. They have also suggested to us some mitigating strategies, and as Ms. Oliver noted, their strongest one is that any independent observer of the city's finances, particularly with this amount of leverage, would be your unassigned fund balance. They view that as the cushion for unplanned contingencies. What rating agencies are looking at very much right now is what is our resilience? If plans don't work out, what's our plan B? That's what they want to know. And how much flexibility do we have? So the big things that you don't have flexibility are on things like pension payments, debt service, those types of things. Currently, today, those things that are out of our control are actually relatively small. So we actually have a high degree of budgetary flexibility. The rating agencies like that. And unassigned fund balance is their strongest view of that flexibility. A couple other things they note going into this. What the rating agencies would want to see is strong public support, i.e. a referendum, that the voters approve this plan of finance, and that the voters were presented very clearly what the tax implications are. That's something that they watch and they would monitor. They would also look for a plan of finance that's not overly reliant on external things beyond our control, like overly reliant on third party paying us for the land. And so when we discuss this, we've modeled a scenario where we get sale proceeds, but we'll also have to think about it, particularly as we go into referendum, and explain to the voters what does this look like if that doesn't happen or if it's delayed. They also noted there are other ways we can structure debt. Level debt service at 30 years for the city is, keeps the debt service on an annual basis a little bit lower than we typically do with the 20-year debt and level principal. There are other things that you can do that are even more aggressive, like interest only for the construction period and things like that. We haven't really had those discussions in detail, but those are things that are available for us to look at. They increase the long-term costs, but they can help bridge some situations in the short term. And so that's really the presentation. And on the questions identified in the sort of the suite of questions under question 12.
Are there other questions? Got a question. Looks like we got two over here. How about you, Mr. Akuma?
Quick question. Are municipalities allowed to do swaps for interest rate purposes?
Swaps?
To hold the interest rate level? Hold the payments level. You know what I'm talking about.
I do, but I'm not knowledgeable enough to comment on it intelligently.
Don't worry, it's a minor point.
Yeah, we can follow
We could
up.
follow up. Okay, thank you.
Sardi?
So I guess the key discussion or thing we need to solve is, with all of these creative financing options we have, are we okay with taking on that risk to finance the $114 million option, right? That's essentially the big question. And I think in the working group last week, we started talking about, well, if we think that was too aggressive, are there different ways to structure? And I think that's what the strategic debt structuring is, i.e. instead of 3 debt tranches, could it be 5 or 6? I.e. could you phase this project over a longer period of time so that you wouldn't have 3 big tranches, and then wait essentially for the MEH debt to come off the books in 2025, for example. That might help level things out. I think that was one option, and I think Bob Jones from Arcadis was there, and I thought he had the takeaway to kind of look into, could you phase out construction of the high school and what that looks like. I don't know whether he actually took that as a takeaway or not, so I was actually going to ask the school board folks if that was an action item, because I do think that's worth looking into. And then I guess the other way to mitigate this is it a $114 million debt? Or, is there the smaller version of this that we should consider too, if we aren't okay with all of these risks involved?
So I can actually follow up on that. Bob Jones did follow up with me in preparation for this week's working group meeting. He's going to bring some materials to that meeting just to get some more clarification on what exactly the working group wants him to model out, and then he can take that and go back and actually prepare it. So he did get that as a takeaway for this week's meeting. The other thing that I would add, just to close out Wyatt's presentation, is that as part of where we are in the process and where these questions fall, a lot of this is looking at the possibility. And so part of the reason, I don't want to put words in your mouth, but I believe part of the reason that it's modeled this way is to look at a very high risk scenario that would make this possible. One of the questions is just very simply 12E, is 120 million possible? 120 million was a number we used. We based it off of 112 based on the last round of numbers, but basically to say, is it possible? And I think the answer here is yes, depending on the risk and the scenarios. So I'd like, from our perspective, for everybody to take this information. Please continue to ask clarifying questions, continue to ask of the working group how we can get to the right level of clarity we need in this information. But keep in mind also that the the goals discussion is set to take place once we have some comfort level around this, and we can do additional scenario modeling as needed. But the goal setting here is meant to come after we get a little more clarity on all of this. So
I've got a question or two. Let me ask you, we've previously spoken about, I think, 120 million. How did that come down to 114, or did I miss something in terms of the total school cost?
Well, 114 is what's in the adopted capital improvements program today. That came about really through the Arcadis cost estimating process, and I think they gave a recommendation that for the program that was contained in the RFP, that was a price that was feasible.
Does that exclude anything though, like site development work or FF&E, or was there anything that is not included because we'll have to pay for it one way or the other? And so I guess I just want to make sure that's the correct number.
It includes FF&E. It includes site work.
Might want to explain to our studio audience what FF&E is?
Furnishings and fixtures. Yeah. That's a $7 million line item in that $112 million budget.
Okay, so we're comfortable that the 114 is all in, the all-in number?
Yes.
Okay. And let me also...
I could let the school board speak to it. I think the school board has the greater intimacy with that number, but that's at high level. That's my understanding of it.
I think those are the best numbers we have to work with now.
Okay. I tell you, I'd also like to see the modeling for no commercial development on the site. It seems like that's something under consideration, and if so, I think we all need to know the financial implications of not having any commercial development on site.
Isn't that the $40 million option, or no?
We didn't get, partly just not to labor through this chart twice. We do have in your packets also another chart that has the $70 million scenario, which is the $40 million for the high school and $30 million for the rest of the CIP, without using the capital reserves, and there is no economic development. Under that scenario, which is about roughly half the amount of debt that we're talking about for the full CIP, the tax rates that would be required are in the realm of 13 cents, and the impact on the median homeowner is about $1,000, which is a way of answering your question that the sale proceeds, when they're factored into the capital reserves and used to smooth off the peak of the debt service, it's very powerful in terms of its impact on those types of numbers. If you do the full 145 million without any land sale proceeds, I think we've run those numbers before, and it was in the 27 cents on the tax rate, that type of area.
Yeah, I just think it'd be important to have whatever is under consideration as a program to have the financials that run with it, so that people can understand if we do it this way, this is what it costs, this is the financial implications for it, and not just, there's 4 things under consideration, here's the numbers for 2 of them. I think we need to have it for all the potential possibilities.
If I could just clarify, Wyatt, under the 20-year level principal scenario, are we using our capital reserves?
No.
So then that $9 million in capital reserves would be available either to be used for the cost of the school, or we could similarly use those capital reserves to shave some of the peak of the debt service for the 40 million scenario.
Both of those statements are correct.
Okay. So I think what we know tonight is the range is between 40 and 120, and whatever number we choose, we will have financing scenarios that we can use to try to mitigate the implications, understanding that we may take on some additional risk in doing that. So this kind of gives us a sense for the range, and when we think about the risk we're willing to assume, we can use some of these mechanisms under different scenarios. And I think what Mayor Tarter is asking for is, if we did not have the 30 million to shave the debt service, would we be able to borrow the 114 million? And if we did, the cost would be higher because we'd not be shaving the debt service, and the risks would be higher. Or we could assume, since we could not shave the debt service, we would have to borrow less. And what is that number if we used all of the other financing elements that we used in that scenario?
have perhaps a similar question to Mayor Tartar's and Ms. Oliver's. The main piece that I'm working my head through in terms of a competitive scenario to a full-on build with either development or not is whether there's a phased construction approach that makes sense. And so it would be helpful to me to see some modeling that shows at least no immediate 30 million using much of the, I wouldn't call them financing games, I would call them strategic financing, including using the strategic reserve to shave the debt and using 30-year principal. And then figure out, if we do that, what's the affordability in tranche one, which would presumably be a set of money that would be a Mary Ellen Hinchin expansion, a first phase on a expansion of George Mason, and enough money to keep the current George Mason operating until you got to phase two. And then when we could get the next chunk of money, and how much that would be to do phase two of the high school, and then open up that land that is where George Mason currently is, either for development or some other use. So it's hard for me to, based on the data we've got so far, and by the way, this is a great job, this is hugely helpful, but I'd like to have some numbers that help elucidate what that scenario would look like and how much money is available in that first construction phase if one uses a phased approach.
Well, with respect to phasing, there's another way to phase it, and that's not with spending, but it's with financing. Let's put 8 cents on the tax rate now and start saving. We know we're going to have these expenditures. 8 years of want, 8 years of plenty. We need to start stockpiling some money. I don't think phasing is something that this body or these bodies can judge right now. I'd need to see an end-to-end proposal that would explain to me how you could demolish a school, build a new school, maintain program quality, and save money all over the course of 4 to 6 years. And if we don't have that end-to-end program, we're not going to be able to make sound decisions. But I do think, as important as attacking expenditures may be, preparing for what are obvious, necessary, and inevitable expenditures is going to have to be addressed. And that means starting to sock away a lot more money a lot sooner.
Yeah, the phasing is easy to model on the financial side. I think it does need to be done in conjunction, I think, with the school administration and with your construction team or your advisors, so that we make sure that what we're modeling is feasible. And I think we can do that. So I think that's probably a next step in this process, because I know the phased one is one of great interest. What is the way we can deleverage this to the city's benefit? And I think we need to work through those. What tonight's is kind of a barbells presentation. Yeah.
Mr. Z?
I am reminded of what Ms. Hardy said with respect to other levers here, and I think what needs to be part of this discussion is the impact of Mount Daniel, where it falls out. And I assume that we'll have some clarity on the final cost real soon. And then the follow-on to that is, because you've now cut a large percentage of Mount Daniel out, what is the requirement for building another elementary school or addition somewhere? And that's going to be money as well. So I think that needs to be part of this discussion. I have to tell you, the kids on my street are ready for high school. They're ready to go to elementary school, so that's a huge concern. So you've also mentioned here other financing requirements. I don't exactly know what that means. It's probably not completely CIP. So mentioned here earlier that there needs to be some pace that we need to be mindful of that will come to us for teacher funding, administrative funding, and school program funding, and that I assume is not part of this 2.5% tit for tat increase based on assessed value, but part of something else. So these are two major components I think that we have to keep in mind instead of just have the simplistic discussion of starting on the layaway plan now as opposed to next year.
Mr. Z, to your point and Ms. Hardy's point about capacity, the next school to hit capacity will be George Mason. The one after that will be Mary Ellen Henderson. The one after that will be Mount Daniel, but we will also have some headroom in Thomas Jefferson. I don't think Thomas Jefferson hits capacity until the mid-2020s. So if we're triaging this, we are looking at the right two buildings. While I understand this will not be the end of our facilities needs, they are and will be the most pressing ones.
If no one else has additional questions, I remind everyone that our next steps as the working group will be to continue meeting and continue seeking clarity around some of the information that we need. And I, again, invite everybody to please continue sharing any questions or concerns you have along the way, because that input is really valuable.
Are there any more questions or comments? Ms. Hardy's got one.
I guess just so that the working group has expectations for what to work on for Thursday, does this group have requests or things that, I heard phasing was one, that's probably the next big thing that we want to try to tackle. So maybe we can follow up with Mr. Jones from Arcadis to make sure that we can, at least operationally, what is the phasing schedule that makes sense, and then financially we can figure out whether we can model that in time for Thursday's work group. Are there other expectations or requests that the full bodies have of the four of us?
Again, I would say that I'm not sure that phasing is something that these two bodies can model, because I just think it's beyond our expertise, and it's going to, Arcadis may be able to inform us a little bit. But the other thing I would say, just in closing to these bodies, is I think Falls Church stands alone as the only jurisdiction inside and outside the Beltway that hasn't addressed its secondary school facilities issues. Alexandria just came out with a very ambitious CIP, which includes construction of a 9th grade school that will be the size of what we're doing at George Mason. Fairfax County, Arlington, Loudoun, all of our neighbors are tackling this, and we are going to have to find a way to do this ourselves, because we are and have been remiss in our obligations to maintain current facilities. And I think at this point, our buildings are beginning to act against our efforts to provide a high-quality education to our students. And so this is becoming a serious issue that isn't going to get any better.
Any other comments, questions? If not, Mr. Akumo. Thank you.
I'm just looking at the two ends, the two bookends of 120 and 40. I'm wondering if that is just too wide a range. Is there some way of sort of coming to a more, it's somewhere in the middle, as my chair said, but maybe closer to one end than the other, but that's a huge range. I mean, if you're providing options, I don't know what we get for 40 million when maybe even soft costs are probably half of that. So I'm just wondering whether or not you could narrow it down, because that saves us having to have meetings upon additional meetings to review 40, review 60, review it. You know what I mean? So just.
Absolutely. And I think had we not presented what we have in terms of financial modeling tonight, I believe the next joint session is scheduled for January 3rd. So we wanted to make sure we had an opportunity to get some of these scenarios together, get a chance for everybody to digest the numbers and see kind of both ends of that spectrum. From our end, as we work with the working group, we have on the school board side, obviously, these different models. We asked the group to consider what could the school system do for 40, 60, 80, 100, 120 million. And on the financial modeling side, we hope to do the same, so that by the end of this, we could look at a cross-section of funding opportunities, school opportunities, and find the path in the middle that makes the most sense for Falls Church.
Okay, anything else? If not, we thank you very much. Appreciate all your good effort, and we'll be seeing you very soon, I'm sure.
Could I ask this one last question? On the financing, who had provided the financial input on the financing options? Was Davenport consulted, Saville Studley? Did they provide inputs, or is this based on prior inputs from them?
The Saville Studley input was a prior input. They're not on contract any longer. Davenport did provide an assessment of the risks of this project. That memo, I think, is in your packet, and they will be advising us throughout this process. And the rest of it really is working with Melissa and in particular in running these different scenarios with the debt service model.
Okay, thanks.
Okay, thank you very much. Okay, let's go ahead and get back into it if we could. If you all could give Mr. Shields your attention. Let's go ahead and move on to the next phase of our discussion if we could. Mr. Shields, let's move on to budget development planning.
Okay.
Melissa, I don't know if this is going to be you once again, but thank you all for the
It will
good
be
work.
Melissa, and Hunter also has provided a couple of slides that we will have, and so it's an integrated presentation. Just in terms of a quick setup, what our goal tonight is to lay out what we see today in terms of our revenue forecasts. We want to identify what we think will be the major cost drivers. We will not present exactly a gap at this point because we don't have all the numbers on the cost side, but we will we will compare against what we envision our revenues being against some of the known costs that we will have to address. For instance, the WMATA costs and other fixed costs that we know we'll have to pay for. And that will be a pretty stark and sobering look when you compare that to the revenues that we have. This all is a setup for the Council's discussion on budget guidance, and that is currently scheduled for consideration on December 12th. And we also, at the very end of tonight's meeting, we do have a copy of the budget of the financial policies if there's a desire to have any discussion or referral to those financial policies as a setup for the December 12th meeting as well. But so first, I will turn it over to Melissa, and she will walk us through a presentation on the items that I just mentioned.
Good evening again, Council and school board members. This is the fiscal year 2018 preliminary forecasts and capital funding presentation. Wyatt has kind of touched on this earlier in his introduction, but I'll just quickly go over the agenda. So we've already discussed the capital funding requirements sort of during Wyatt's initial presentation, former presentation. We're going to look at fiscal year 2018 preliminary revenue projections, and I call out the word preliminary. And then we will also indicate some cost drivers that we're currently seeing, known costs that we know are coming on board for the schools and general government. We'll provide an illustration of just one way of looking at what, distilling the facts that we're presenting you tonight. And then we'll go through the budget calendar and give a summary and the key issues that we're facing it with this year. So for revenue growth, we are projecting a 3% revenue growth with a range of 2.5% to 3.5%. We are still early in the fiscal year to see how FY17 is doing against our projections. So we'll have changes to this come January, February timeframe. That does mean $2.4 million, $2.5 million of new revenues for both the general government and schools. In high level, the expenditure needs we have for our capital program, we will need some PAYGO money for maintenance and for equipment. And as we've discussed earlier, reserves for the George Mason High School project. On the operating side, there will be some increases in WMATA, and school enrollment is going to drive some of the costs in the school board, as well as remaining competitive on the compensation side for our staff. In the region, just to give you an idea, assessment value growths have been minimal in the region. Arlington is projecting a 2.1% total AV growth, including new construction. Fairfax County is projecting 1.4% AV growth, and Falls Church is actually doing a little bit better at 2.75%. That's what we're projecting right now. And go ahead. Sorry.
Do we think we're being too aggressive then, given what our neighbors are projecting?
This is actually something that the real estate assessor had provided me, and he indicated that the reason Fairfax County is actually dragging down at 1.4% is because they have a lot of industrial sites and also land areas like golf courses and things like that that are just not, that are kind of dragging the increases right now. So apartment buildings are actually doing better in Fairfax County, but they are being dragged down by these other types of commercial activity, which we don't have.
Say Arlington at 2.1.
Correct. I mean, again, this is a number that I have from the real estate assessor's office, and he's pretty confident that we're going to be around that number. He is still processing sales information for December, though, so I just want to point that out. There is also one thing that also does distinguish us currently is that we have a lower than average in the Virginia region, Northern Virginia region, vacancy rates in the commercial sector. Our vacancy rates are about 6%, whereas the Northern Virginia average, including Arlington and Fairfax County, they're looking at 16 to 18% commercial vacancy rates. The county is also experiencing significant drops in federal procurement. Right. So just to kind of emphasize how important the real estate assessment value is in our revenue projections, this pie chart shows that 60% of our revenues do come from real estate taxes, with about another 25% coming from other taxes, BPOL, meals tax, sales tax, personal property tax. And the other taxes include amusement taxes, recordation taxes, cigarette taxes, and communications taxes. Yes?
Quick question. On that 59%, how much would you say, or just ballpark, is residential versus commercial in the city? I know it's huge. I mean, a huge portion of it is residential, but I'm just curious.
Yeah, about 22% of it is commercial. About 9% of it is apartments now. That's been going up.
That's been going up. I'd have to go back for that number.
And then the remainder is residential.
Again, just to kind of break down what the increases are in excess value in the residential, we're projecting a 2% increase, with 1.2% being from market activity increases, and 0.8% from new construction, and that's about $15 million, which is a projection for now. This is what we've had in the past several years. On the commercial side, it is a 4.5% increase, with 1.75% from market increases and $30 million in new construction. Overall, it's that's what we're counting as the 2.75% AV growth. This kind of just shows where we are in the region as far as real estate taxes. These are the cities above are sort of our peer in population, with Fairfax City down here also our peer. So other than Fairfax City, we are sort of the lowest in the region on the small side, small population cities and towns. So this is another representation of that information. This is Falls Church, and again, this is our peer population, with the outliers being Manassas Park and Fairfax City. Just to take down further on some of our other taxes that we consider to be the sort of the economic indicators for our budget. Personal property, we budgeted $5.2 million in FY17. To date, we've seen better performance on that at $5.5 million, and so we're projecting a 6% growth, and that is something we will look at that might maybe adjust in the next few months. And this is just a representation of the graph over several, the activity over several years on personal property tax. Sales taxes, due to the new development that we had this year, we did already budget a 12% growth over last year in sales taxes, and first quarter is looking pretty good. It's meeting our targets. We're going back to a normal average growth of 3% in FY18, absent any other indications otherwise. This is just a graphical representation of what's been happening over the last few years on sales tax. Meals tax, we did budget just a slight increase in FY17, and we're kind of doing a little bit better than that this year. So we'll be watching that closely in the coming months. I've currently modeled 3% growth on the meals taxes, and that is sort of going to a 3-year average of increases, 3 to 5 year average of increases over the last several years on that. As you can see on this, meals tax is pretty stable. Beginning 2014, it's steadily increasing, but not huge, dramatic leaps. Overall revenue forecast, again, just recapping, 2.75% growth is projected for real estate. Other revenues are about 3.3% with a total revenue growth of about 3% for a total new revenue of $2.5 million. Now, on the expenditure side, just to, before we delve into detail, just to give you an idea of what we've been doing over the last several years on the general government, both of these numbers exclude debt service. On the general government side, 7-year average is 2.2, 5-year average is 4.0, and we come back down to a 3-year average of 1.7. This does reflect kind of coming out of the recession and taking care of the things that we needed to take care during that time frame. You'll see the same pattern in the school transfer, with 7-year average being 4.8, 5-year average going up to 7.7, and 3-year average coming back down 5.7%. Now, going into the known increases that we're facing in, I'll talk about the general government side, and Hunter and perhaps Bob are going to talk about the school cost drivers in the next few minutes. So on the retirement side, oops, sorry. All right. The asterisk was to indicate that this was from our actuarial valuation. Sorry that came off the presentation, but we are expecting a $220,000 increase in retirement costs, and that is mostly due to a change in mortality tables that was used in this year's actuarial valuation. It was recognized by the pension board that we have been using an older version of the mortality rates. I want to say it's from the 1980s, and they've changed it to a more current one, which is more indicative of longevity and mortality rates in the last several years. So that was the main reason for that increase. Health insurance, we don't actually have numbers right now from our provider. We are plugging in a 15% increase, just because last year we had a 26% increase, and the current indicators are not such that we would think that we'd remain flat in that aspect. That will change. We do just want to point out that that's one thing that we're concerned about. Yes.
Ms. Ryman, I remember it was either last year's budget or the year before where we ended up changing the health insurance based on what the cost was. And I know that last year we were past the point when we could actually make changes. What is that date, just so that we know and can manage towards that if we need to use that as a lever? I know that's not something we take lightly, but.
I think we'd have to get back with you on that date. It's probably, it would need to start now.
Early.
Pretty much. Yeah.
I mean, it would have been something that we have been looking at earlier than today, just because we would have to competitively procure that, gather some data as far as experience. Not to say that we can't still do it, but the sooner the better. And are we looking at that right now?
It's not currently on our work plan to put it out to bid.
Do we think we're going to need it as an option, though?
I have maybe a naive view that if they bumped us up that much last year, that we're going to get a break this year, but I don't know. I don't know how that.
I just want to make sure that we don't leave that as an option and then realize we needed it.
So just to follow up on that question, if I could. So when is it we find out, quote, what the new rate is?
Yeah.
It will be January. Okay.
And then
last year we found out
in March.
A bit later. It was March.
Yeah.
So
They thought they were doing us a favor by and actually they did. They did by including additional months of experience, which actually brought the increase down. But we found out extremely late last year.
So we're anticipating finding out in January. If we don't like the rate, what do we do in January?
I think we'll have to consider what our options are, and I'll need to get back with you in terms of what exactly the steps would be to procure that.
I mean, at a minimum, we should have as much leverage as we can, right? And so I think that would be a good idea to at least contemplate what an alternative would be.
Mm-hmm.
Because 26% is a lot of money.
Yeah.
Thanks.
on the plus side, we are seeing a decrease in our required contribution for retirees' health insurance. And that is actually mainly due to a change that we made last year in our health insurance coverage, where we only started, we're now only providing Medicare supplement to our retirees. Whereas previously we were on a full benefit plan. They have the option to choose plans A, B, C, D, or whatever Medicare provides. And on top of that, we're providing a little bit to supplement that. Yeah.
And have you withdrawn any piece of that, the main part? I mean, they still have the A and B, but you're saying that you're only offering the supplement now?
Right,
but
correct.
You're not offering the parts A and B?
Oh, we're not. Medicare is doing that.
Oh, okay.
Yes.
All right. Thanks.
Yes. So our retirees now have Medicare as their first provider and the city as their secondary provider. So that gave us some significant savings on that side. And absent any plan changes, we should continue to see the reduction, this new level of funding for our OPEB plans. On the WMATA side, they did just present their proposed budget for both operating and capital. Operating came out in November, and capital just came out recently in December 1st. We are looking at cash contribution increase of $500,000. We'll go through in more detail what that is. And then we put in here PAYGO capital maintenance. This year we used the remainder of our land sale proceeds to fund PAYGO, and that was $670,000. So we're putting in that we should continue that funding. Now, this is just showing half of that with the rest of it on the school side. But we are recommending continuing that funding so that we don't fall back again on our capital plan.
Mr. Ryman, one question on that. Is that assuming we adopt, I know we'll talk about financial policies next, is that assuming we adopt the $1 million a year PAYGO reinvestment?
Correct.
This is the first part of that?
Although this is half of that $600,000 requirement.
So the 600,000, there'd be 300,000 for schools, 300,000 on general government. That's generally where we want to be at a minimal level of capital reinvestment.
And that's predominantly for facilities, and FY17 is the last of PAYGO or any money for reinvestment on regular maintenance of facilities besides the big capital projects we've been discussing.
So on WMATA, currently our cash contribution is $3,034,182. For FY18, they're asking in round numbers, we don't have the exact numbers as yet, $500,000 total, and that's made up of $200,000 in PAYGO capital contribution, for which 85% we've been told are already planned investments that are already underway. So a lot of the discussion had been, well, can we push back on that? Can we defer them? And the answer had been that, well, 85% of what we're planning to do in FY18 is already underway.
So this is smart track and things like that.
Rail cars, rail tracks, things like that.
That are already under contract and
committed. $300,000 in operating. And the reason for that is they are projecting a 10% decrease in revenue.
From fares?
From fares, correct, and parking. 2% increase in costs, operating costs, and that turns into a total of about 15% increase in overall local subsidy. From all the jurisdictions participating in Metro. Yes, Mary Beth?
Is this just a one-year thing, or are they telling us it'll be another $500K the following year and the following year?
It's not cumulative, but certainly this is a new level of funding. They did present some 6-year numbers, which has that information.
We're doing a conference call at the staff level with WMATA tomorrow, and also are in the beginning stages of discussing the capital financing agreement, which is a 5-year plan. Council recall earlier in the spring we adopted a 1-year extension of their plan, and so we're looking at the out years. But 18, 19 through 22 doesn't see a major drop down. It's going to be continuing at this level and slightly up as reinvestment into the infrastructure happens.
Now, speaking of the capital funding agreement, in addition to the $500,000 increase in cash contributions, we may be called upon to provide $1 million in something that we can debt finance. Now, we can either debt it ourselves, like issue the bonds ourselves, or opt in with a WMATA debt, where they will issue the debt and we pay an annual debt service on that. So they're estimating about $1 million of that for this year.
So why we didn't count any of this towards the debt models we just looked at?
We did not.
Thank you.
We literally just, we found out a few days ago, sorry.
Is that $1 million in debt or $1 million in debt service?
This is $1 million in debt in FY18. Now, as Cindy alluded to earlier, we are not seeing any drop off until 2022, 2021. So they're expecting $1 million every year from us in the next few years.
Over and above everything else.
Over and above everything else.
And what's the service on that approximately on an annual basis?
And it's probably going to be a bit lower than this, but okay, so just looking at that, So on the $1 million, this is in addition to the $500,000 cash contribution. State funding is possible at around 25%, depending on the types of assets that are being funded with this $1 million. Currently, we are receiving between 17% and 34% on most capital items from the state. So we don't know yet exactly how much we're going to get since this is very new. But with that, so we could be looking at $750,000 from us and $250,000 from the state. So possible debt service, depending on interest rates, obviously, could be between $130,000 to $170,000 a year.
That would start.
On the $1 million.
It's principal and interest, not just interest.
Right.
And you're anticipating that would be each year there'd be another $1 million for seeing
Right.
a few years?
Hang on one second. I have their capital budget.
While you're looking at that, Cindy, could we use the toll money from I-66 for any of this? Do you know?
Toll money cannot be used for WMATA on the operating, but yes, for some of the capital. Also, 30% NVTA can be used for WMATA like we're doing this year. We need to keep the investment in the CIEDO in order to have the match to get your 30%.
Okay.
We can probably
Okay.
get back.
We can get back to you on that. Also, the capital funding agreement is still in progress. A lot of jurisdictions are discussing this proposed budget from WMATA. Everybody's sort of in a shock mode and digesting this right now. They do intend to adopt the budget in March 2017. That's the current plan. I think last year they actually didn't adopt it until May.
We're having a lot of discussion, sort of a catch-22. We need to know what they're planning so we can provide their budget, but it's hard for them to adopt the budgets till the localities have approved their budgets, so. And additionally, we're still continuing the work with the state to push for increased funding for capital and their support of Metro and all transit statewide so that it's all borne on the localities for WMATA.
Is there any word on Metro at least hearing us out on restoration of 2 bus lines they've cut out, or is it still their position that they're going to tell us what's best for us and not hold additional hearings on those 2 bus lines that our constituents keep reminding us that they want?
That is certainly a discussion that DDS planners and I are bringing up with them, especially when they deliver this. But it's not just replace the 3T. It's looking at what that service is that's cost effective for us, for our citizens, who are the predominant users of that.
Well, in simple terms that I can understand, is that a yes or a no?
Maybe.
That sounds like a Metro answer. Thank you.
Just wanted to channel them for you. It's a no if you want a definitive answer as of tonight.
Other things that we have not put a number to in the previous slide are some of our key budget drivers is to provide competitive compensation for our staff. And then, which compensation is about 57% of the general government budget. And then we also have not yet heard from our interjurisdictional partners as to any cost increases that they see on their end. And interjurisdictional agreements are a little over 10% of our general government budget. So little movement on those 2 items could give us more room or more consternation. Also, in FY17, the city manager identified $2.3 million of unmet needs, and so none of those are included in the previous slides. I will turn over the mic to Hunter and Bob Schiller.
Great, thank you. In terms of start off with some enrollment information. In terms of where we are in the current year, our September 30th fall membership number, and the fall membership number on September 30th, that is the year-to-year benchmark that we use to compare one year to the next. It's the number that we report to the State Department of Education. That number this year was 2,670. And that number 1 year ago was 2,509. It's an increase of 161 students, or 6.4%. Last year at this time, when we were working up budget projections, had anticipated about a 3.4% increase in student enrollments, which would have put us at 2,595. So we missed the mark by about 3%, or 75 students. So we are currently in this fall are working with 75 more students than we anticipated coming into the system. In terms
Hunter,
of,
just to stop you, and maybe you'll get to this in the next slide, do we know whether that surprise 3% is evenly distributed across class sizes? Are they coming in the lower grade levels? Do you have any trends or data on that yet?
At this point, yes, you're right. On the next slide, what does that mean in terms of class size? And for my purposes, it's more cut and dry to look at grades kindergarten through 8. They use a different algorithm at the high school where they're on a block schedule and the course loads shift. But this is basically classroom core content teachers. On the far right-hand side is the school board's class size policies that we try to stay within, which is class sizes no greater than 22 students per teacher in grades K through 2, and 24 per teacher in grades 3 through 8. At this point, we've exceeded those policies at the 3 grade levels: kindergarten, 2nd, and 5th. You can see especially at the 5th grade, where all the classes are either 24 or 25 students. At kindergarten, they're nearly all at 24 students.
So slightly different was my question.
Sure.
Is
okay.
I'm curious about whether they're evenly increase, the surprise kind of enrollment that we saw, whether it was evenly distributed, because I wonder whether we're seeing increase in student population across the board, i.e. people are just moving in at all grade levels, or whether they're coming at the really young ages, in which case we're just not capturing or getting data on the people who have not yet entered kindergarten, in which case that's concerning because we need to make sure we do a better job of that for the going forward years.
Yes. Can I get back to you with that information? And you're absolutely right. Kindergarten is the most difficult grade to project.
Hunter, could we also include pre-K in that? Because I think that went up significantly this year, just so that we know what percentage of this is the pre-K level.
Sure, just in terms of the numbers.
Yeah.
Absolutely.
How many of the increase came at Jesse Thackeray?
Certainly. Great. In terms of where we've been and where we think we're going, on the left-hand side, the green columns are the actual fall memberships going back to FY '99, and the orangish red bars on the right-hand side are the Weldon Cooper projections that we were provided by that organization. At this point, given where we are and what Weldon Cooper is projecting for fall September 30th of 2017, it's an increase of 89 students at this point. And I'll tell you, when I do the analysis of where the kids are coming from, I will include this on a grade level projection as well of where they see the students coming from. As Ms. Ryman said, on the city side, what about 57% of the general government's budget is dedicated to staff salaries, benefits to personnel. I know everybody knows this, but on the school side, we're very much a people business. That 85%, nearly 85% of our budget is actually in staff salaries and benefits. As Dr. Schiller pointed out earlier today when I was working with him, if you include the purchase services in that as well, which includes, for example, student tuition, it would be internet, telephone, utilities, building maintenance, technology, insurance, legal fees, security guards, school nurses, things like that, really basics to run your program. You add that 10.3 and that 84.6 together, about 95% of our budget is fixed.
I would like to point out, since I began my interim position last week, but doing a deep dive into your budget because I've been doing this for the last 8-9 years as a consultant around the country. And so with the very able assistance of Lisa and Hunter, we are tearing through everything that's been requested as a bubble up process in the budget and trying to get our arms around just what it is there and what we can do, what we can't do. First of all, these breakouts are consistent with what school district budgets look like nationwide. There's nothing aberrant about the percentages dedicated to each of these areas. And as Hunter pointed out, clearly one of the major drivers is being here, the population growth and the cost with the benefits and the personnel to be able to accommodate that. The other point that we've done, I've wanted to expand our circle of advisors, and so Hunter and Lisa and I are going to each of the schools to work directly with the principals for me to get a better understanding of what it is that their true needs, and not just that it's on paper, because they are obviously our first line of communication of information, as well as a communication with their parents and constituents. And we completed that with the elementary principals, because one of the things I was interested in not only was the increase of enrollment and some of the requested additional staff, but what does that mean with regard to cost of supporting that? Do we have room? Or Mount Daniel, would we have to add another trailer? And what is the cost? And some of those things were not necessarily factored in your original early budget. Tomorrow, we'll be going to Henderson and the high school, because I want to bring the principals into this fold, because we need their valuable insight. The key that I think is, as we'll show in the next slide here, Hunter, is much like the city, the best guess estimate that we have at this point is what the fixed costs are going to be with regard to benefits and retirement and health insurance. Nearly $900,000, give or take. Now, Hunter, how comfortable are you with those numbers?
Comfortable to the extent that there should be asterisks up by the VRS and the health insurance. Those could very well change. As we discussed earlier when the auditors were here, the VRS retirement increase, this is a result of accelerating the fully funding of what the VRS board and actuaries had recommended back in 2012. This was an initiative of Governor McAuliffe. If, for example, the governor recommends and the General Assembly approves, or even if the governor doesn't recommend and the General Assembly goes ahead and listens to the pleas of localities and goes ahead and reinstates the original plan, this $450,000 item could go to zero. But we don't know that at this point. We'll know if the governor is including it probably, we will know whether he's including, what rate he's including by mid-December, probably in about 2 weeks. And then we'll know what the General Assembly action is, because this is a short session coming up by the end of February. So we hopefully will know that by the time that the school board would adopt its budget request. Likewise, Melissa and I have been working together with the health insurance, and the 439, the 440 here represents a 15% increase. God bless you. Mm-hmm. I'm cautiously optimistic that this will come down for two reasons. One, going back and doing some analysis on last year's health insurance, and because we were previously with the Council of Governments with United Healthcare and then had switched over to local choice, I went back and modeled to say, what if we had stayed with the with the United Healthcare, with COG, and then built in their rates plus their average increase over the previous years. And believe it or not, we would still be better off cost-wise with the local choice program. It was still slightly less than what the premiums would have been under the modeling assumptions. And the information that we're getting right now, it's a little fuzzy. Melissa and I and our HR folks are putting our heads together, and I think we're going to be placing some phone calls. On the one hand, we're being told that our experience this year is very similar to the experience last year, which on the one hand says, it hasn't gone crazy and done something different. So there seem to be some trends there. The question becomes, will a rate increase be necessary in order to continue to make up for the deficit in the previous year? But like I said, we should know something by February about that. The other items, the VRS life insurance, the city retirement, and the other benefits are pretty much knowns at this point. The other benefits, as Melissa said, the reduction there is primarily because of the retiree health insurance and the change in the assumptions there, and the city retirement increase as well.
So the amount of elasticity in this area is going to be floating for a little bit, much like at the city. We have to work that, but I think we're all looking at least a starting point from which we have to plan, for which we have very little flexibility. What would you say, variance? At best, 10%?
Well,
15, or even more, because
the odd thing is, if the VRS is if you make an assumption it's either going to be $450,000 or nothing.
Yeah, that's a big difference.
That's a huge difference.
Exactly.
Yeah.
Much like the city, you have the key budget driver where, for general government, you want to provide competitive compensation. My board has also identified the fact that there is a range from which they would like to see the competitive compensation with regard to on the salary guides compared to other school districts. So that enters into it. So, the bottom line comes down to what we're seeing here is that obviously our collective needs are greater than what we probably will ever see to be able to be funded. But if indeed we are sticking with the notion of almost $900,000 for the base benefit and insurance package, how then do we address the competitive salaries? For an example, just a step increase for administrators, support staff, and professional staff is almost $1 million. Just a step increase. $988,000 is projected out. A 1% adjustment to all salaries is another $374,000. It can go on. Well, clearly, we're now beyond what may be the revenue base. And that's assuming that everything else remains static in next year's budget as it is today. No additional staff for some of the ballooning class size grade levels, and certainly what has not been adjusted for a period of time, and which our principals know that quite well, are the materials and supplies in some of our areas. Without getting into other needs and wants to expand program, to maintain and enhance an already outstanding program that you have, that's what we're facing preliminarily. The need for adequate classroom materials and supplies, very critical. To maintain competitive staff salaries, and obviously to address the staff services due to student enrollment growth. These are the areas that my board is going to be wrestling with as we start next week. The budget that we are going to put together is the board's budget. It's certainly not the interim. My short time here, it doesn't mean that I have ownership. I'm in support of the board. It's their ownership of the budget. By the time a permanent superintendent is on board, likelihood she or he will have little or no input into the budget. So it is indeed, and for fiscal year 18, the board's budget. And tomorrow night we will be getting our direction from the board in terms of how best we can serve their needs in order for them to be able to present to you their fiscal year 18 budget.
Just a quick question. The school cost driver slide for $890,000, there are other cost drivers that may be mandated by law in addition to these, correct?
That is true, especially in the area of, say, special ed tuition and services, and I can think of some other areas as well. But these are those to which we can assign at this point, given certain assumptions, a price tag. So I think those other items to which you refer are on the next slide, which basically fall under the student enrollment growth, making sure that we have the staff and the services necessary, or in some cases are mandated or required.
But those, just to be clear, those could be a couple $100,000 as well.
Easily.
So they're not,
easily.
because they're people largely.
Right. But I, at this point, cannot assign a dollar value.
Understood.
On that note,
That uplifting note.
to continue on to what Bob mentioned earlier. So this is just one illustration of what we're dealing with. So if we take our total revenue growth of $2.5 million, we take out the requested recommended PAYGO capital maintenance of $600,000. Right, it'll be split 50-50, but we take it off the top. Debt service of $120,000, which was from what we issued earlier this year. And we're also making an assumption or a decision to put in to withdraw not withdraw, but to reduce our retirement contributions by $143,000, representing the pension dividends that have been earned on the $9.2 million over the last 2 years. That's FY15 and FY16 earnings.
What's that breakdown into an annualized return?
Less than 1%.
Yeah, and it's important to realize when the decision was made to invest in the pension fund, markets were at all-time highs. And they dropped, and then they got back around June 30th of this year. We got back to all-time highs, and so that's really the trajectory that they've been on. They kind of went down for 12 months, and then they came back up. So this is obviously lower than the average returns that we'll see from the pension over the long haul, but this is the net result. This is the ROI of that investment to date.
If we take all that into account, we will have
With that pension dividend, I thought that was all going to go to pay capital.
Well, so we've put it right next to debt service, just for illustrative purposes. Now, notionally, it was actually dedicated to the Mount Daniel project, or at least at the time that was on people's minds when that decision was made. We've been paying Mount Daniel debt service now for 18 months, and so at any rate, it is a cost reduction, and we put it side by side with the debt service figure.
So the remaining funds for operations, available funds for operations, is slightly under $1.9 million. Now, we take that against what we've heard previously on the general government side of about $740,000 in known costs, without any increases in staff or programs or any increase in staff compensation. And on the school side, $890,000, similarly without any increases in staff compensation or programs. And our net available funds for anything new would be $234,000.
Ms. Ryman, did that include the WMATA costs?
Yes, our $740,000 did include it. That did not include any capital reserve funding that we may wish to pursue early in order to fund a planned high school, middle school development. So there's a decision to make here. You can, as Wyatt alluded to earlier, you can begin to build reserves early in fiscal year 2018 rather than fiscal year 2019, is what one of the models showed. Now, debt service, if we issue in FY18, the first debt service on that will potentially begin in FY19, and that's on the $10 million that we had projected. So only a small portion of it will show up in FY19. And this represents basically 50% of the FY19 projection of what's needed to put into the reserves. So we had included 8 cents, and this is 4 cents. So if you begin in early in FY18, you could potentially do 4 cents. And then another 4 cents, not cumulative, in FY19.
Ms. Ryman, this pre-funding, is that just school construction?
Well, that's pre-funding to set. We would set aside all the receipts of that tax increase and put that into the capital reserves for the project. We wouldn't spend any of it.
Right, but I'm saying, is it you're earmarking? What I'm saying is that all that is going towards school construction.
Yes.
But there's nothing for CIP for the city or.
Now, this would be purely a strategic investment to begin to pre-fund the high school project. That's what this is put out here for. So we put it out here for a couple of reasons. One, I think we're talking about an FY18 budget. We've got a lot of tough decisions to make, and we're going to work through those as we always do. But just thinking about where we're going to be next year at this time, and we're thinking about this big capital lift that we're going to be have right on our plates at that time. 4 cents is half of it. And so what we're proposing here is just to start thinking about is you could do that in 2 steps, 4 cents this year, 4 cents the next year. None of these are going to be easy decisions, obviously.
Why, did the 8 cents that we talked about in the modeling include City Hall and the library in there?
Yes, that's the full CIP.
So if we did 4 cents now, then the 4 cents, say, the next year, that would take care of the library and City Hall and the rest of Mason?
What's that blue?
It's 8 cents total, not 8 cents plus, because I think the library was like 1.5, City Hall was like 2.5.
I mean, the modeling did include the full CIP, so you're right. This 4 cents would be for all the CIP program that we have.
Where did the blue one go?
So just to quickly go down through the months, the budget calendar. On December 12, we have a regular session for council budget guidance. January 10th is when the superintendent's budget presentation is to the school board. January 30th is the CIP presentation to Planning Commission. February 28th, school board budget recommendation. March 13, the city manager will present the budget to the city council to include the school board's budget recommendation. The 27th will be the first reading. April 10th will be the public hearing. And April 24th is the scheduled adoption of the budget. Second reading, second public hearing, and adoption of the budget. Just to summarize back what we've kind of gone through. So we're currently projecting a 3% revenue growth for $2.5 million. Known cost increases, including the WMATA, are $2.2 million, and this does include the PAYGO $600,000. But just again to remind everybody, this is prior to considering any changes to compensation or additional programs that we may need. And as we've heard previously, we've identified capital needs, and this is just what's been adopted through FY 2017 of $145 million. And these present a significant challenge to our financial capacity. We will continue the community discussion on a shared vision for our capital programs and budget priorities over the next few months. And that is the end of our presentation. Thank you.
Thank you both for a great job, or all three of you for a great job. Do we have additional questions or comments? Okay. All right, well, thank you very much. I know this will be a continuing discussion. And I guess we look forward to the rest of the further discussion.
So sure how much we all look forward to
What's
this.
that? Sure. Vice Mayor Connolly has a comment.
And what's the vote?
I just, as the school board gets ready to leave this joint session, it occurred to me as we were sitting here that we've probably had a record number of joint school board and city council sessions this year, from January until December. I tried to count them as I sat here, but there were so many other numbers going around. So we're going to say it was at least 20. And we're really wrestling with some big issues. So I just want to tell everyone here that I appreciate how much we're really digging into these issues and looking at it from so many different perspectives, because I know that everybody in this room wants to do right by the city. So thank you all.
All righty. With that, why don't we go ahead and move on? Are our folks from school board going to head on out now? Are you guys are you going to stick around?
Well, the other thing is, if you're a glutton for punishment, I think the next item up is the revision to the fiscal policy. Is that right?
Yeah, we're going to cover the fiscal policies which impact our ability to finance. So if you want to,
So you might want to stick around for that because it could be informative.
Let's go ahead and have a seat if you would. If you're going to be leaving, head on out the door. And let's go on to the next phase of our meeting, which is city fiscal policies. Mr. Shields, we will turn this on over to you, at least for the initial portion, and we want to hear from our chair of our Budget and Finance Committee, Ms. Oliver. But why don't you take the first stab at this, and then we'll go ahead and pass it on to
Very good. We've been working hard with the Budget and Finance Committee. We've been beating these policies up and poking them and trying to make them better and responsive to what we need to accomplish here. The big setup, and I think everybody's heard the speech before, but these financial policies are really here to serve the city council and serve the city towards accomplishing your long-term goals. And so, when it is important that the council buy into them as you consider these and ultimately adopt them. In the staff report, there's a summary of the major issues that we're trying to address. And the big picture is under, as we've discussed in the prior part of this meeting, under current policies, we will run up against those policies and trying to accomplish the major capital projects, and specifically the high school project. And so there's key things that we would point you to. At
Mr. Shields, I'm sorry, do you have a PowerPoint for this?
I do not have a PowerPoint.
Okay. I know, but it'd just be good for the public and everyone to have.
Yeah, we
Is it in the?
Well, those at home as well.
It is in the P drive.
Is it online?
I'll
put it on.
We're gonna put it up here on the board in just a moment. So I would point the council to line 186 of the policies. I'll give a quick summary, I think, of the key things for discussion. So at line 183, our policy, which has been on the books really since 2001 when the council first adopted fiscal policies, is that debt service shall not exceed 12% of general fund operating expenditures, including the school board budget and the general government operating budget. So we would add an additional provision that says that in the event that an extraordinary capital project requires debt service to exceed 12% of general fund operating expenditures, the city shall increase unassigned fund balance to 20% of general fund operating expenditures for any year in which debt service exceeds this policy. So this recommendation really comes from Davenport, and their view is that the 17% policy is a very normal policy. It is not extraordinary. The amount of debt that we're contemplating in our CIP is extraordinary, and therefore it would behoove us to take, if there was one thing that for us to do that would be meaningful to the rating agencies and to independent investors in the city, is to make to increase that resilience or that cushion for plans not working out according to, as anticipated. And so that's really what that represents. We considered some different options for this. We've also had discussions with them about the fact that, yes, we're right now at 17.8% of expenses. That's where we ended the fiscal year. We've got over $9 million in capital reserves that are dedicated specifically to this high school project. Together, that's 27%, of essentially uncommitted funds with respect to our expenses. Their view was, well, your capital reserves are part of your plan of finance. And so the rating agencies are impressed by that. They think that's good. That's good as part of a plan of finance. But in terms of true resilience, those capital reserves, they may be expended more rapidly as part of as things go out, or at any rate, they're in play. Whereas your unassigned fund balance is really reserved for what they care about, which is your resilience to deal with any kind of shocks to the system. So that's what that language is. For us to get there, we need to increase our, if we took 3 years to get there, we need to get $6 million more into unassigned fund balance. That's the lift. That's a pretty big deal.
So is this coming exclusively from Davenport, essentially exclusively from Davenport?
Yes, that is who we've had. Those are the discussions we've had. Now we are in process right now of talking with the rating agencies because they're doing their annual surveillance. They do emphasize to us that unassigned fund balance is the thing they tend to care the most about, but it's something that is super clear in a locality's finances, and that's probably the strongest thing that they look at in any rating.
So I guess my question would be, or maybe a statement, depending on how you view it. One, I guess it'd be good to know from the rating agencies directly, right? That's really who we're concerned about, correct?
Yeah.
In other words, the point of doing what is in blue and writing here is to make a rating agency happy, right? So I think it'd be good to get that information directly from them, which it sounds like you're in the process of doing.
That's right.
I would just make an observation as well. It's sort of a double whammy. Like, in other words, when you want to borrow a lot, they want you to both borrow a lot and save a lot, which means you get hit on both sides. In other words, you have to basically potentially increase your taxes for debt service. At the same time, you may have to increase your taxes for more savings or unassigned fund balance. And so it's kind of like you're getting hit coming and going in this scenario. I'm not saying it's good or it's bad, but that's just what I observe, because that's going to be a pretty big hit. To borrow more, you have to sort of double up and save more at the same time. To borrow more, you have to save more.
Could I ask, could you translate what you just said into tax rate numbers? So you're saying an extra $2 million a year over the next 3 years, each year?
Yeah.
So you're saying another 6 cents on the tax rate to do what Davenport is recommending?
Well, what we
roughly,
I would say the simplest way that what we could do, and what we laid out in the last slide of the last presentation, would be to get there, do 4 cents on the tax rate a year early to build up those reserves. And I think that's a strategy that we would recommend.
So, I mean, I don't know if is now the time to comment, or are we just...
Sure.
I mean, I've tried to attend as many of the Budget and Finance meetings as I could. I must have missed the one where this was discussed. I mean, I find this to be shocking. I mean, if it's possible for you to continue the conversations with the ratings agencies and raise some of the points that the mayor raised, I think that would be useful. I mean, I would certainly like for the public to understand that, you know, the way you sketched out the 27% equivalence of a fund balance is, you know, the direction that we are headed, and that this would be in addition to that. I don't know. I mean, my concern would be, to draw it a little more broadly, that we're talking about passing a budget in April that would theoretically increase the tax rate by, I don't know, 8 or 10 cents before we have designed and made the case for the school's facilities that we're going to go to referendum on in November. And I would be afraid that since we have not had time to make that case, which I assume we'll make mostly over the summer and fall, we'd be risking some sort of earthquake that would redound to the disadvantage of whatever school facilities policy we're trying to, get passed at referendum. I mean, that's, I was going to share with the interim superintendent that what you said about, we face a challenge in the budget as we always do, and we work through it as we always have. To me, the good news is that, economic growth has been pretty robust. Assessment is up. Thanks to, our commitment to economic development over the years, we're actually in a better position, as far as I can tell from reading the newspapers, that they are in Fairfax and elsewhere. And, my, at least, personal objective is to try to get us to convince the voters to build as good and big a new high school as we can. And I'm just concerned about what I hear about how we're thinking about designing this budget tonight, that's not going to get us off on a good foot when we go to the voters next November.
Mm-hmm. Ms. Oliver?
So, Phil, on this particular item, we're taking a look at the fiscal policy. And the question is, what do we need to do to be smart about the future? And what Davenport is telling us is that to be smart about the possibility of borrowing up to $114 million, we need to put additional monies aside. So in putting this in the policy, we're acknowledging that that cost and that risk is associated with that riskier option of going above our standard policy. Separate from that, the two bodies need to make a decision about what level of financing we're willing to take on. And I think it's important to be very clear that if we are going to take on that maximum financing that we've been discussing, that there is an additional cost associated here with having the unassigned fund balance that we need to be prepared to accept. And we could talk to rating agencies and we could tweak this slightly, and maybe it's not going to be 20%, maybe it's going to be 19%, or maybe it's going to be higher, or maybe we could talk a rating agency into considering our capital reserves, or maybe not. But at the end of the day, our advisors are telling us that the lenders are going to want to see additional monies available for resilience. And that's what we're trying to put in the policy, acknowledging that we recognize that we will need to demonstrate additional resilience.
Ms. Hardy, then Vice Mayor Connolly.
So I think I understand the intent of needing to boost our unassigned fund balance. My question is how we arrived at the 20%. Because I know the 12 to 17% range was generally 2 months of expenditures. And so I get that if you're going to leverage yourself more, you need more savings in case you default, or you just have a bigger safety net. How do we arrive at 20? Feels like that percentage should be proportional to the extra amount that you're borrowing, or some relationship somehow between the two. For example, what if we went way above that? Would 20% be enough then, right?
I don't know there's any magic to 20%, to be honest. I think it's here's the broad advice, is that rather than, and we had a lot of debate in the Budget and Finance Committee, is it better to keep your policies unchanged and break them, and have, when you break them, just have a good plan of finance and you explain why you're breaking them and how you're going to come back into compliance? Or is it better to build into your policies some flexibility that contemplates you may break them, but if you break them here, you make them stronger over there? And really what we are doing is that approach. We're going to break the 12% policy. We're going to make ourselves stronger in the way that the rating agencies care the most about. That's it operates really at that level. Now, it has real world ramifications to get there, But we've been, for most of the city's history, we've been above 20%. The reason we're at 17% right now is because we have made decisions to put that any money above 17% into capital reserves or to make sure it gets programmed. When we built Mary Ellen Henderson Middle School, our fund balance was at 35%, and nobody was really paying really close attention to it other than those bond investors. So 20%, I don't think, I think we can get there.
Vice Mayor Connolly?
I'm just marrying that information with the chart that we just went through.
Yeah.
And basically, it shows us exceeding the policy limit for 5 years. And then we go back below the policy limit. So if we put that money into unassigned fund balance for 5 years, we're at 20%, and we don't ever need it because everything's working out perfectly, then that money is available for capital reserves. It doesn't have to stay in unassigned fund balance forever, right?
That's correct.
So it becomes a flexible piece of our capital planning into the future if we don't need it for resilience. And if we do need it, then it's there.
I guess I'd make another comment as well. One, I mean, I appreciate conservative fiscal policies. I share them. I'm not sure keeping a lot of cash where you earn 1/10% or thereabouts, it really is a good fiscal plan for long-term savings. I mean, it's basically like putting your retirement in your Wells Fargo savings account. It ain't going to pay off in the long run. And I think we're doing a lot of that in the city. Maybe it's some of it or a lot of it's due to state regulations regarding what we can invest money in. But the reality is if we keep money 5 years, inflation is going to eat away with that. It compounds each year. And so maybe at the end of 5 years, you have 10% less money than you started with in real terms. And so I have a concern about that, and I think we do a lot of that, and I think we should really understand the full ramifications of parking a whole bunch of cash somewhere for a period of years, because time erodes the value, inflation erodes the value of money. And so I don't have a great solution for that, but I think that's something we generally have not considered in the city, and I think we ought to spend more time either figuring out how to boost our returns or to put that money effectively to use. For example, hey, we're going to use this money in 5 years, but we're going to go borrow money at 4% in the meantime for some other purpose. Well, and we borrow a little bit less money on the front end with something else, earn effectively 4% on our money because that's what we're going to pay to bond folks potentially, as opposed to earning 1/10% on our savings, which is what we do. So, I mean, it's kind of convoluted, but the idea really is just to make effective use of our cash, which I'm not sure we do as a city for a lot of reasons, and that's just the point I would make.
If I may, I think as long as that money isn't being borrowed, so it's within a relatively tight time frame, and it's money you're not borrowing, then I think, I don't know what the payback period would be. Obviously, 10 years sitting at 1% is not good, but parked for a couple of years to save 4% in interest payments down the road, I think that's probably cost effective.
Well, I guess what I was saying is, for example, we got water sale proceeds a couple of years ago. That money's been sitting there and it may sit there for a couple more years. When you add all the total time up, it might be 5 years where you have about $10 million and some of that money went to, half of the money went to our pension, which is earning, presumably over time, will earn the historical norm of about 7%. The other part is earning probably more like, 0.5% or something like that, some blended rate less than 1%. And so, for example, we're going to probably borrow money for a library. We're going to borrow money for City Hall expansion or renovation. And so that's going to start the clock on 4% money as soon as we borrow it. And so I think, and I'm not necessarily saying, well, we should put our cash to work on those things instead of borrowing as much money, but I think we ought to consider that, because when we take borrow 4% money and we keep 0.1% money in the bank, there's a big delta there that we're losing out on. So that's really all I'm trying to say, is that we really, I think, ought to be cognizant of that. And that's my concern in part with keeping a whole bunch of cash for a whole bunch of years in rainy day fund. So I've said it before, and my apologies. Yeah, Vice Mayor Connolly.
Last year, we agreed to allow the treasurer to invest unassigned fund balance in the VIP pool, right? And this money could also then be put into that, which doesn't make a ton anyway, but makes more than the previous investment, right?
It's still
Correct.
fairly minimal, right?
It is very minimal, and just to point out, we are limited by state laws as to what we can invest in. So AAA bond ratings, U.S. Treasury, state, local government, bonds, those are the things that we can invest in, and they don't pay a whole lot of money. We did start investing in longer term securities, but still that's only between 3 and 5 years. It's earning a little bit more, but not much more. Certainly not enough to cover the interest rate that we're paying on some of our debt. One thing, though, there was I think a statement about what if we use this money in our rainy day fund to instead work towards actually building things like the library. Well, then that means there's no money in the rainy day fund. I don't know if that's sort of the question there, maybe keeping a balance of what remains in the rainy day fund versus buying down debt.
Well, I guess to me, I'd want to have that discussion because I think that when you say let's park a whole bunch of money here, to me it sort of eliminates the idea that maybe it could be put to better work in a more productive way for the city in the meantime. And so I don't have an answer, but I'm raising the question that I would like to have further discussion. And when I see things like 20% here parked in this account, and then you've got an assigned fund balance with some more money, all of a sudden you're talking about some real money that's really not earning anything for anybody. It's actually losing money over time. So that's just the point I wanted to make. I don't want to belabor the point.
Just if I could add one more thing. Yeah, when I first came on and tried to begin to understand what the unassigned fund balance was in 2013 and why it was the size that it was, I was steered towards the folks at Davenport and had a conversation with them that was fairly extensive. Now, that does not make me the world's foremost authority. I did not stay at the Holiday Inn last night, but I mean, it was helpful to me at the time to get that sort of very detailed explanation. That, I understand now our situation's different. What I basically heard at that time from them, I'm going to say emboldened me to, proceed down the course that I have since I came on council to try to keep, us budgeting conservatively, but, making sure that our money is always being put to the highest and best use. And if this is something that, other councilors are interested in exploring, this 20%, then I guess I would just ask that, maybe we could have Davenport come in and speak to us directly, make sure the press is here, get Bob LaJeunesse in the room. I mean, you know where I'm going here. I mean, this is something that we have sort of fought over for at least 4 years. And I do think that we need to do it in a more deliberative and public way, because as your memo says here, these policies that we enact do have a fiscal impact, and we don't pretend otherwise. So I guess I would just file that as a request, and I'm not sure that fits into the timetable, but I think that would be helpful.
On that note, I think we had talked previously about getting this in a commentary in the newspaper. Is that possible before a vote on this? Just so that the public's more aware, especially since it could have pretty near impacts to the tax rate.
It has not been done yet. It's on the work plan. So then, let me point out just two other that are really relevant to, I think, the high school project specifically. The next is at line 200, which is the payout ratio. We talked about that in terms of our metrics earlier in the evening. What this basically says is that, one, it explains why we have a payout ratio. And so compliance with this policy means that debt issued by the city will have a term not exceeding 20 years. In the event that an extraordinary capital project requires a financing term that exceeds 20 years, but not to exceed 30 years, the city will take such steps as necessary to return to policy within 5 years. Now, when we model our debt service, we come into compliance in 5 years. And so, in some respects, this language is convenient because the way we've modeled it, we think we're going to achieve that. It's just it creates some flexibility, and then it creates a timeline to get back into compliance. So nothing too clever about it, but it follows the philosophy of, instead of breaking a policy, acknowledge it and have a plan. Then the last one that's relevant to the extraordinary capital project, and that's sort of a phrase of art that you see in 3 places in the financial policies, and the last one is at line 317. And that is basically a statement, and this is not unusual in municipal finance, that capital reserves may be used for debt service provided there is a planned financing program as part of an extraordinary capital project. Now, that's not our practice today, and this policy would basically embrace that as a viable plan of finance for an extraordinary project. So those are the ones that are really relevant to the high school project. There are a few others that are noteworthy, and I can just summarize those very quickly. I would point you to line 320. And this is the setting a kind of a level of effort target for pay-as-you-go capital at $1 million per year. The city shall approve a capital program that includes both cash funding from general revenues and may include debt issuance. Debt issuance shall be made only within the parameters of the debt management policies enumerated in this policy. And the city's goal, and this is the salient piece, the city's goal for cash funding is at least $1 million per year. Any funds not appropriated for use shall be placed in the capital reserve. We currently have $460,000 of pay-as-you-go funding. That's part of the reason for the discussion for the $600,000 FY18, but $600,000 is also what our practice has been over the past decade or so of what our annual cash reinvestment in our capital plant has been. And it's for things that are not really suitable, or, it's not great to debt finance HVAC system repairs and elevator repairs and things like that. So you do need some cash for those types of things.
But the policy doesn't necessarily direct whether it's personal property. I mean, you're just sort of referencing personal property or equipment or fixtures. There's no differentiation, though, between seeking to not debt finance personal property versus, capital, real property. Like you sort of verbally suggested there was a difference. You don't want to finance HVAC system, which is like a fixture. It's not a building. But there's no differentiation. You guys are not recommending a differentiation in here as to not debt financing things that have short life, right? Like a school bus.
We don't speak to that specifically, although there is a policy that says no debt shall be issued for an item that has a depreciation schedule that is shorter than the term of the debt. That is in your policies. So, for instance, when we do police cars, we structure it as 5-year debt. That's how long we use a police car for.
Okay. Anything else of note you'd like to mention?
I think those are kind of the main points.
Questions, comments?
Could I just ask a question about that 1 million? So that number comes from, am I right, the staff report on line 47 has a set of numbers that explain where we get $1 million, that we have $106 million in capital assets, replace them every 10 years equals 1 million equals 1%. Is that, we had talked earlier about, again, trying to explain to people how many police cars and dump trucks and sand loaders and so forth that we have. Is this the sort of simple way to convey that?
I think Richard Lacondre came up with that specific sentence. Is that correct?
He did. That formula was Mr. Lacondre's formula. But yes, it's
pleased to know that he actually answered my question, or at least tried.
It is 1% of existing capital assets, and that's basically, and I don't know if we've talked to our DPW folks about it. It's a maintenance effort to just keep the buildings working. Buildings and also replacing the smaller machinery and equipment that we do own.
Do we have the hologram of Richard that we can play?
Yeah, really. I guess I would say again, I mean, I'm not looking to make more work, but, this is a significant amount of money too, obviously, and would require a tax increase. And so, some sort of an asset replacement schedule spreadsheet. Yes, sorry, me too. That's Richard coming back.
There he is.
You were supposed to play that a while ago. Good.
Some sort of asset replacement schedule that you probably have tucked in some drawer somewhere that, again, could be shared with the public. So you can answer the question, why do we have to buy sheriff's cars so often here in Falls Church? I mean, it's only 2.2 square miles, but something to show that we got a plan and here's the number of miles that we replace them at, and it's smart to do that because it's better than repairing them. I mean, you get where I'm going.
And again, this is not just capital replacement, it's maintenance like roof and HVAC systems and things like that. So I'm not really sure that Cindy is the capital person here, so she can perhaps have some input on it.
Well, although that we've been speaking about Mr. LaCondre, this is one of the items that we've been looking at for a long time in terms of getting reinvestment into our assets. So we're not currently looking at all our facilities having needs right now and how to hold them together until we can do those big projects. So it certainly is facilities, those items that are usually 5 years or less. It is also the vehicles, and it is also our IT equipment. We do not have asset replacement plans funded. We do know what they're valued at. We do know normal end of life and best practices. And so that was the basis of taking that universe and funding a steady replacement plan, so we're not peaks at crises, but we can steadily maintain those. So it varies by facility or piece of equipment.
Okay, other comments, questions? First of all, I'd like to thank Ms. Oliver. I know you spent considerable time and effort, and the Budget and Finance Committee and staff that supported it. And John, I guess I could thank you as well. No.
I was just going to ask if I could horn in and ask a question.
Absolutely, of course you. Well, thank you for your question. How about that?
And I think we talked about this at one of the Budget and Finance meetings. Is there a definition of what is an extraordinary capital project?
The ECP is the George Mason High School.
ECP equals GMHS?
Okay, I mean, know it when you see it.
Okay, so I would also think it'd be good if we could get that commentary out. We've talked about that for about a month and a half, and I think the public would have a better idea what we're contemplating, which could have significant impact both on the high school and on a tax rate. So I think getting that information out one way or the other would be very helpful. But anyway, thanks again. I know a lot of time and contemplation has been spent on this over the past months, and so much appreciate your fine
And
work.
I just want to add, I do appreciate all of the members of the Budget and Finance Committee, and thank you to John and Justin for staying for this portion of the conversation. I think it's also really important that we take this forward next week.
And Lawrence, too.
And Phil.
I haven't finished.
Carol, get Richard LaCondre in here.
I think that it's really important that we approve some sort of fiscal policies next week, so that we know on the basis of which we're going forward with our budget guidance and ultimately our budget. And we've made an effort here to try to do a really long-term look. And I know that there is some discomfort with some aspects of the policies, and we can take a look at that. I would ask people to let me know if they believe that they can't, if you can't approve this policy, can you approve it with a change? I would want to know what your thinking would be. But I do think it's important that we wrap this up before we go into the budget period.
Okay, thank you much. Is there anything else on this topic? If not, thank you all for sticking around and for coming out. And your budget guide. No, we'll do budget guidance. Sorry, let's do a little bit of budget guidance then as our last item here.
Take one and pass it around.
What's that? All right, well, thank you for sticking around as long as you did. Do we have a motion to stay beyond midnight tonight? Not yet.
Okay, for budget guidance, there's one thing that on the resolution, before we get started, I think there's a sentence that's worth noting. At line 29, I'm sorry, line 21, one of the whereases just notes that the budget process is designed to provide many opportunities for citizen input, and that will ultimately inform the council's final decisions in the spring. So that sort of sets the tone that this is guidance at the beginning of the process. You will have latitude to change your minds later on, but this is to help give some parameters to management as we put our budget recommendations to you. And then in this last whereas, it gives you the opportunity for some additional bites at the apple if you wish to take them. So that's sort of in the preamble. In terms of the text that's before you, a lot of the text comes from old versions of council budget guidance. The highlighted text has been modified and updated for current conditions. And so at line 50, right up front, we want to reference the city vision and comprehensive plan. It's anticipated that by the time you get this budget, you'll have adopted a new vision. And so I think it's helpful to keep that in mind as we consider our priorities. Line 57, that's language that basically encourages cost effectiveness and working with the schools in a collaborative way for finding synergies and ways that we can deliver services effectively through mergers, contracting, partnerships, and other means. 62, it would be a place for the council if there are key things that you do actually want funded in the budget or priorities that you want to make sure are addressed in one form or the other. That is a placeholder where that discussion could occur. It's left blank at this point. Line 66 is where we would typically have guidance on taxes. And at line 68 is the example of how that's been expressed in the past. One thing that has always been difficult about the budget guidance that's been passed and adopted in the past is that there's a carve-out, basically that parenthetical, not including the school division in terms of presenting a budget that does not require an increase in the real estate tax rate. And so that does leave open the question from the manager's perspective of is the manager to solve that issue, or is the manager to deal with what's under the manager's control and present that aligned with the council's guidance, and the school board budget just sort of is as the school board goes through their process. At line 73, there's a call out. Basically, the standard language is that it needs to be in accordance with adopted financial policies. And then there's an additional sentence that relates to the fact that in the CIP, we do bump up against those policies. If there's any variance, the budget presentation should be very clear about where they exist and provide an explanation. Line 78 is about public information, and so that's been moved up. It was the last bullet in years past. I think the Budget and Finance Committee wanted that moved forward. Line 81 references providing some context for FY19, some initial revenue projections and some expense projections so that the decisions for FY18 are made in that context. 84 speaks to a level of employee compensation that is competitive within the region. And line 88 The sentence, the capital improvements program should meet the commitments of the city council in the adopted 17 through 22 CIP. And this came out from the Budget and Finance Committee just to have some fidelity to our prior adopted plans as you present the CIP, and so that reference is made. The next one at line 93 relates to transportation funding, and basically the message there is maximize our NVTA funds and try to put that money to work in the city. Line 99 is to make sure the budget makes clear about the investment made in the pension fund, that's shown clearly, so that there's not confusion on that point. And the last one relates to fleet replacement. So that's the draft that's before you, and I think there's probably be happy to have any discussion, but I think probably the most substantive ones are there at line 62 and 66.
Okay, any questions, comments? Okay.
Excellent.
Yes.
So I do think tonight we should hear a little bit from people about what they think the top priorities should be, so that we have a draft. I mean, it could be 1 or 2 or 3, but if we do want to call anything out, we need to know what people are thinking.
When you mean call out, what are you specifically talking about?
So line 62, the idea is that we identify for the manager any funding initiatives that we want to see, things that are very important. An example might be, given all of the discussion we have had this year about the neighborhood traffic calming program, one could put the neighborhood traffic calming program here, telling the city manager he better find money for it this year, since we've had so many conversations about funding that after the fact. Or maybe this year we don't think that's important, and we're prepared to let him figure out whether he can do that or not. Another priority could be make possible financing the campus project in future, lay the groundwork for future funding of the campus project. So those are examples of the types of priorities that we might want to call out.
There are certain things that we know are coming that we don't, like the new voting machines. Are they in this year's budget or next? They're in this year's budget. I mean, do they have to be priorities or things that are included?
Are they already included, essentially? Have you already decided?
They were not in the gap analysis. That are being funded through the CIP, and so that's something I need to figure out a plan of finance for. That's a $200,000 item, I think. Is that what it is?
2 to 250.
It's a state mandate, and so that's something that's going to have to be addressed in the budget.
And what's the lifespan of them?
Mr. Berkey indicated 10 years with
Or
software
until
updates in
someone
between.
decides.
Well, the
until
General
there's a new
Assembly
mandate.
Go back
changes
to
the
crumpled
tool.
pieces of paper
Yeah.
as the safest way to do it. Okay.
A question on this stuff that's supposed to go in section 6 or line 62. Is it supposed to include things like the capital stuff that gets mentioned further down, or school excellence that get mentioned further up, or what's supposed to go there? Is it wholly stuff that's in general government? All of the above?
Yeah. I did envision it. I think when I presented the budget last year, I knew that there was a desire for traffic calming, but I didn't realize it was going to be sort of the main, such a big issue as we went through the process. So I think this was envisioned as a place for the council to say up front, what are some things you want to just make sure are funded. The EDA has put a recommendation for downtown improvements, that those could be funded through an increase in the hotel tax. The council could speak to that if you want that to be built into the budget. I think that's a reasonable way to fund things that have come up, like
Lights.
Yeah, right.
Okay. Do we have any items for this?
I like traffic calming.
All right.
Just take it off the our agenda for continued discussion. Let's just put this in here. That's my tar mark in the sand.
All right, what else we got?
I do think we need to say something about the extraordinary capital project.
Mhm.
All right, what else we got?
So I have my three, I guess, in no particular order, or I guess don't hold me to it. So I'd like to see long-term capital infrastructure needs.
That's your first priority.
Don't hold me to it.
I'm kidding.
While we've got our school board member here, school excellence, especially around small class sizes. I know we're trying to commit to a lot, but that one I'd like to see us get back to. And third is downtown vibrancy / walkability, including traffic calming.
Okay. What else we got? Say city council salaries?
Yeah, that's exactly what I was thinking of. Well, I mean, I don't want to. I don't want to shift attention away from this paragraph, but you know, in order to even embark on this paragraph, thinking about it, I have to start with the paragraph at 68. And I mean, one thing that we had talked about at some point in the budget and finance process was whether procedurally we might here in the city replicate the version of a budget presentation that the county does, where the county manager actually does present a budget in which expenditures don't require an increase in the real estate tax rate. And, you know, put it on the manager to present a budget. Of course, charter obligates us to present a budget that incorporates whatever the schools ask, but the council, as I understand, is entitled to ask for, you know, whatever it wants. And if it wants the manager to present a budget without a tax increase, that is something we could include in our guidance. I mean, I don't disagree with any of the priorities that everybody here has listed. I'd probably add Christmas lights and holiday lights and voting machines and a few other things, but I don't want to advance those without making the point I just made about what I would hope that the council could see from manager this budget go around that we've not been able to see in the past.
In terms of the language that we might have for line 66 onward, I don't want to see any language about the real estate tax rate. I don't think that's the way to be looking at this right now. We know that this is a tough time. We know that we have an extraordinary project. We're trying to put long-term fiscal policies in place, some of which could cost more money. You know, we do have important initiatives, investments in the long term of the city. I would really hate for us to talk specifically about the tax rate. I think the old language in which we said general government expenditures don't require an increase. You know, that basically holding the general government growth to the organic growth rate. I'm comfortable with that, but I'm not comfortable with anything that attempts to restrict the tax rate at this time. I don't think that's fiscally responsible given the burdens that we have, that we know.
So what are we proposing for line? Are we just dropping that paragraph then, or? Right now we do what you say, and we, you know, don't have any mechanism for taking a look at the school budget through the manager's eyes. Are you suggesting that we just keep the language that's there now, or drop it altogether, or?
I think my point was that I could live with the language that's there now. I would not like to see language that specifically limited the tax rate at this time.
Okay, so we're basically violating the Legendre doctrine, as I understand it, which was, you know, the purpose of budget guidance is to guide, you know, the manager and the school superintendent as much as we can in some direction, but whatever that direction is. I mean, maybe there's a 6-vote majority here to tell both of them to, you know, go to town. I don't know. I don't know what specific guidance you want to give, but if we leave the language in as it is now, we're just, well, we know what we're doing. We're sentencing ourselves to the usual, you know, months-long back and forth, which, you know, the managers said, you know, we go through, and, you know, there's some good that comes out of that, and I'm familiar with it and happy to engage in it. I'm not sure this is the best year to do it, because I would like us to be able to focus on the extraordinary fiscal, or whatever we're calling the. I really would like the two bodies to be able to focus on that as the main, you know, piece of work between now and the end of April, but I don't know what others think.
Well, do you have a specific recommendation for language that you'd like to see, and we can assess whether you've got
Present a
additional
budget
people?
in which expenditures do not require an increase in the real estate tax rate, is what I would say.
Yeah, I don't, personally, I mean, if we're starting with something, that's the place I'd like to start with. And there's a lot of pressures this year, and I'm sure they'll be pounding on us from every different direction, and I don't know what we'll end up with, but to me, that's a pretty good starting point for the discussions. But otherwise, it really isn't guidance. It's just, we got a lot of priorities, we're going to try to do the best we can, and then that to me is sort of where we always end up anyway.
Dan, where are you?
Well, I think it's generally understood that we want to keep the taxes as low as possible, but however, I'm also a firm believer that at some point in time we have to put money into being ready to have the resources available to embark on this project. And my feeling is the longer we don't do that, the longer it's going to take to get the project. At this point, I'm not even sure that we're going to be able to get a useful referendum issue out by next year or so.
I mean, I think in some ways you can separate capital expenditures from operating budgets, and I think there's some utility in that. In other words, you could say, I want to keep the tax rate flat, which maybe sort of where I start off with. And I understand there's a lot of pressures, and a lot of those pressures are not really operating budgets per se. They're really capital pressures. And so I don't know how to parse this in a way that particularly provides direction as to operating budgets, again, which have a component of debt service. But nonetheless, to me, that's sort of one of the critical elements to be able to afford capital expenditures of many, many pennies, or maybe more than a dime or more, that you have to have some operating budget discipline to get there. And so to me, that's the point I think ought to be made, because I don't think we're going to be able to afford 8 cents or 27 cents or whatever the number is if we don't have some discipline in operating budgets along the way. And so I think that's a message that ought to be conveyed, whether it's, you know, this word or that word, but that's a message I think is an important message to be heard.
Letty, do you have a thought?
So I share the perspective that I think it's important to separate the two, because discussion, I don't think it's realistic to keep the tax rate flat for both, knowing the capital pressures we have. So if there's a way to kind of separate the discussion, I think.
I think what will make next Monday go as smoothly as possible is if we have a sense for language that people are prepared. I don't want to be doing this on the dais Monday night if we can help it. I know we don't necessarily have agreement right now.
What if there was a paragraph that basically stated that goal, which is, it is the council's intention to maintain discipline on operating budgets in order to maintain fiscal capacity to accomplish our significant capital goals, or something like that. So it's not specific, but it does lay out a philosophical approach that would be guidance, I think, to the school board, the community, and specifically to the manager.
I'd want to see it and think about it a little bit more, but I think in general, that's closer to what I was thinking than maybe just.
I liked what you said, Wyatt. I think the old version where we just said we want to keep it flat is just unrealistic.
I like it anyway, but. All right, well, why don't you put something together for us to consider along the way?
And write that guest commentary. Now more than ever.
Yeah.
Remember, noontime by Wednesday.
Yeah.
600 words.
I think it's actually Tuesday. He's going to want it by Tuesday.
800 now?
Wednesday at noon.
Wednesday at noon? Oh, well, that's easy.
Cindy, I need you to do this today. I need to invite tomorrow morning.
Thanks, Mayor. Give them the ideas.
All right, what else we got on this? We have any other
So where are
comments?
we on our top priorities?
I think we got everything everybody put in. I don't know if we.
we heard a few, but if we want to limit it to 3, we have about 8.
Traffic calming, walkability, and something about physical discipline.
Traffic calming.
Downtown vibrancy, walkability.
That was in order of Letty's priorities, I think.
Right. Capital projects.
And school excellence.
School
Yeah.
excellence, long-term capital. Some of those larger things, do you think they're not addressed in the preamble?
That's what I was confused about, whether.
Supports the city's excellent schools and
'cause-
excellent government
Yeah,
services.
some of it's up top and the capital stuff's further down, so I didn't know
Yeah.
what's the set that goes under that line 66.
I was thinking it's more sort of specific.
Specific to general government priorities.
Yeah, like if there's traffic calming, sort of the walkability, traffic calming, and downtown beautification. Those are 3 things that, okay, I know what those mean, and got to work with staff to make sure we're resourcing those. That's what's intended. That's what I was envisioning for this bullet, not sort of the broader things like school excellence or long-term capital obligations.
That's what you're thinking, then I would broaden them to maybe more like transportation,
Okay.
because that would
We do have
include
a
some of the
bullet on
bikes.
transportation at line 93.
Why don't we just tell Wyatt? I mean, that was from this time.
it all.
Put it in here. Wyatt, this is what we want. Make a note of it.
Maybe that paragraph 62 isn't actually necessary, since everything seems to be everywhere else.
Right. So we could add in.
And mention the vision and comprehensive plan in the very first.
Yeah. Okay. Yeah, and at line 95, the focus is on walking, cycling, those types of things.
Okay.
Does focus mostly on MBTA. That does focus mostly on MBTA where neighborhood traffic calming may not fit, so we may just need to broaden.
How about we get rid of that paragraph, but we try to sprinkle these concepts elsewhere in the budget guidance? Okay.
How about a sign on the truss bridge that goes over Washington that says, "You're now leaving Arlington, Falls Church is 100 yards ahead"?
Yeah.
Yeah, 100
Can't
yards
get that done?
Yeah.
If you could, on that topic, update us on what's going on, like if you have any designs.
If we say welcome to Falls Church at the sign, all the Crescent kids are going to start showing up for school.
Well, that's a great,
People rent those apartments.
that's a great
Could I ask-
segue for the VDOT public hearing on Thursday at Mary Ellen Henderson and Paul's drafted comments, so I'll be getting that out to those that were hopefully attending, including the overpass and the west entrance to East Falls Church.
All right, what else do we have?
Could I ask just one specific, on this page 16 graph here, chart, which gives a recent history of operating expenditure growth for the general government schools. So can you match this up against enrollment going back 3, 5, and 7 years? Just so I am aware of if the school transfer has increased 7.7% a year over the last 5 years, has that
Yes, we can
tracked
provide that
against
for you.
enrollment?
We can provide that for
Okay,
you.
thank you.
All right, what else do we have? Okay, can we move on to, wait, does anybody have anything, comments, scheduled? Anything at all to mention? All right, go ahead, Dan.
Move to adjourn.
All right, let's do it. You guys want? We're out of here.